alongside Brad Smith, and let's get you the three things that you need to know this morning.
Good morning, everyone. First up, futures falling right now after U.S. stocks hit record highs yet again. Both the S&P 500 and the Dow Jones Industrial Average closed at record levels on Tuesday as investors shrug off potential tariff risks from the Trump administration. All eyes now turning to today's economic data.
Treasury yields are falling as investors are awaiting October PCE data this morning. Now for the latest read on the Fed's fight to tame inflation. Meanwhile, traders are digesting data, including the second reading on third quarter GDP, showing that the U.S. economy grew at a solid 2.8% pace amid stronger consumer spending.
And a slowdown in the PC market, hitting shares of Dell and HP this morning. The long-awaited recovery of personal computers is stalling after a bump up earlier this year. Computer purchases are getting pushed into 2025, according to the CFO of Dell. Meanwhile, tariffs loom over the space, with the CEO of HP telling Yahoo Finance some of the costs will have to be passed on to consumers.
Some of that will have to go to consumers, given what is the overall margin that we have in the categories. But again, we need to wait and see what the final tariffs are for us to define what the exact plan is going to be.
U.S. stock futures are fluctuating this morning ahead of key inflation data next hour, and after the Dow and the S&P 500, they closed out new record highs on Tuesday here. That's the setup in this holiday abbreviated trading week here. There you're taking a look at the futures this morning, where you've got the Dow up by about 0.1%, the S&P 500 and the Nasdaq, though, in negative territory, just barely here. And a few things that we're keeping close tabs on, especially in a week where, abbreviated as it may be on the trading front, you're still going to get some economic data out even later today, as we see the Fed's preferred inflation gauge, PCE, come at 10 a.m. There's a lot of commentary kind of coming into these prints. One of them from Sonia Meskin over at UBS in summary, saying that, yeah, FOMC participants, they sound pretty chill considering everything going on around them. That, of course, coming off of those meeting minutes. And then additionally here, some additional meeting minutes commentary. David Rogal, who is the lead portfolio manager for BlackRock for the Total Return Fund there, he was talking about labor market data being noisy, weather disruption strikes, looking through the noise. They think that hiring is stabilized in the mid to low 100,000 range. What does all this mean? That's the setup going into the final FOMC meeting in December here, and final meeting of this year, rather, in December, yet to come in just a few weeks here.
Yeah, I think when you take a look at the data out this morning, once again showing that the economy does remain resilient. Yes, you can take a look at the continuing claims number, maybe within the jobless claims print that we got out this morning, saying that shows some weakness. But again, that overall headline number did decline just a bit. So that, of course, will be good news when you talk about the ongoing strength that we are seeing within the labor market. And then the GDP number that we got out this morning, not that far from that 3% level, shows very steady economic growth. I think the big question is, as we do see a change in the White House come the new year, come mid-January, just what exactly the focus is going to be for the street and for economists, for investors, whether or not it's going to be more of a driven by some of the policies coming out from the Trump administration, or if it's going to be more Fed focused. We know very much the focus, obviously, on the street over the last several months has been surrounding the Fed and Fed policy and what exactly that looks like as they do work to tame inflation. But I think as we do get more details and more commentary from the incoming Trump administration, that, of course, is going to drive some of the likely behavior that we're going to see, not only from consumers, but could also drive the market sentiment as well.
Yeah, I mean, it's a larger kind of balancing act, especially for the Fed, as you consider the fact that they've been moving to and through this broader policy pathway that they've laid out for cuts. Going into next year, it seems like many of the economists are anticipating a cut every quarter. But when you have President-elect Trump talking about some of the tariffs that he's looking to impose and ultimately how that gets rolled out, that could throw a little bit of a wrench in the Fed's broader pathway that they've already communicated to the markets thus far. And the markets, of course, don't like that uncertainty. So we'll see exactly, once we get to that point, exactly how the markets start to digest some of that as well.
All right. Well, as mentioned, investors are awaiting the Fed's preferred inflation metric, core PCE. That's due out later this morning. Meanwhile, the second read on third quarter GDP showing that the U.S. economy expanded at a solid 2.8% pace. Let's talk about that and more with Mark Zandi. He's Moody's Analytics chief economist. Mark, it's great to have you back here on Yahoo Finance. Let's talk about the data that we did get out this morning so far. We had the jobless claims number, pretty steady there. We had the GDP number, a lot to be encouraged about. I guess my question to you is, how sustainable do you think the growth is as we look ahead into the new year?
Well, Sean, I think the fundamentals are pretty good. The economy is on very solid ground. Consumers are doing their thing. Businesses are investing and hiring, and everything is kind of moving in the right direction. The fundamentals feel good. I mean, the thing that that I think is most important is the growth in productivity. The U.S. productivity growth has picked up in a meaningful way over the past year or two. And I think it's increasingly the case that this is due to kind of longer term forces, increases in investment and business formation. So lots of good stuff. So I think the economy is going into 2025 on very solid ground. Now, obviously, there are lots of potential storms coming, but I think this economy can weather many storms that will be thrown at it.
What are the storms that you're continuing to be on watch for right now?
Well, I'm not a fan of broad-based tariffs. They make me really uncomfortable, nervous. I mean, I get strategic tariffs of specific products and countries to try to make a point and to, strike get people to play fair, the Chinese in particular play fair. But kind of the broad-based tariffs that's in the debate discussion right now, 25% on Canada, Mexico, another 10% percentage point increase on Chinese imported goods. That, I know it's negotiation. I know, we shouldn't take it all that seriously. But on the other hand, broad-based tariffs, they're just a negative, what I call a negative supply shock. They're a tax, so they raise inflation and they diminish growth. Just exactly, the wrong policy. So that would Brad would qualify as a storm.
Mark, talk to me a little bit more just about this policy uncertainty risk, or what you just said there, the risk here that the inflationary picture or the tariff picture could categorize here as a storm. I guess, is policy going to become the defining element as we look ahead to next year, and almost the Fed will be more of a secondary thought?
Well, yes. I think it's going to be about economic policy coming out of the new administration. Everything from the tariffs that we just talked about to immigration policy, deportations, and of course, tax and spending policy, right? I mean, there's got to be a very large tax bill that's got to get passed in 2025. And I'm sure there's going to be a lot of work on spending as well. So big fiscal policy changes, dead ahead. And so I think that's front and center. And the Fed's going to just have to react to that. They're going to have to calibrate monetary policy interest rates to make sure that whatever these policies are and how they play out and whatever they do in terms of growth and inflation, that, they calibrate policy accordingly. So it's all about economic policy. The Fed's going to be kind of a bit player, but it's got to get it right. Otherwise, this really good economy that we're experiencing now will be significantly diminished.
And so all this considered, with regard to the Federal Reserve, it seems like for several quarters, they've been in a little bit of a recalibration cycle, at least as UBS has been kind of qualifying it here. I wonder how you look at where we are in the broader arc for the Fed, especially with the incoming administration and what's been talked about to this point, but also how they can kind of just keep blinders on and to what extent they can do so without some of those outside factors influencing their policy decision.
Well, I mean, the federal funds rate target is 4.75%. That's still really high. I mean, it's down from 5.5%, which is where we were, back 6 months ago. But 4.75 is very high by, kind of any measure. There's a lot of debate as to what the so-called equilibrium rate is. That rate at which monetary policy is either supporting or restraining growth. But I don't think anyone thinks it's 4.75. So I expect the Fed to continue to normalize rates. They're going to probably cut rates in December, at least once in the first quarter of next year. But Brad, having said that, if we do see big changes on the tariff front and immigration front and tax spending policies are very uncertain, that may, I think the reaction of the Fed may be to pause, rate cuts, because they don't know how's this all going to play out, and what does it mean for growth? What does it mean for inflation? I don't really know, so I'm just going to stop. So I wouldn't be surprised if at some point early on in 2025 and through much of the year, the Fed's just on hold at a very high interest rate because they just don't know. The uncertainty's just something they can't navigate through.
Talk about just how the market has reacted, because lots of talk just about valuation levels. You can argue when the economic fundamentals are so strong or as strong as they are. Yes, we should see some of this euphoria and excitement play out within the stock market. But is there some concern just about how far we have come at this point?
I'm concerned, yeah. I mean, I think valuations have gone from highly valued to overvalued to bordering on frothy. You can see it in the equity market. You can see it in the bond market. Look at corporate credit spreads. That's the difference between yields on corporate bonds and treasury yields, risk-free treasury yields. They're paper thin. So investors really aren't asking for any compensation for the risk that they might not get paid by those businesses. You see crypto prices, you see gold prices. Everything feels very stretched to me, particularly in the context of rising long-term interest rates. I mean, if you go back 2 months ago, the 10-year Treasury yield was at 3.6%. Now we're at 4.25%. We had been as high as almost 4.5% not long ago. That's a big increase in interest rates. But despite that, asset prices, equity prices, the values have risen. So I do think this is something that is an increasing risk. I usually, I'm an economist, a macro guy. I don't really talk about valuation in markets generally, except at times when they feel off kilter, when they're too low or too high. And right now they feel awfully high. These asset markets are priced to, some really good news, nothing going wrong. And, that doesn't feel like what's dead ahead of us.
Yeah, Mark, I know you're not an equity guy, but you do have great insight when you talk about just what exactly, and putting it in perspective, just how far we have come on both the economy front and also the equity front. I'm just curious, just following up to those comments, and it sounds like a meaningful correction may be in the cards at this point.
Yeah, I would not be surprised at all. And when I say meaningful, it's not one of these, down 10% on stock prices that comes back next week. We've been getting these kind of, mini corrections that last a week or two. I'm talking about something that is more substantive than that, like down 20, 25%, and we stay down for a while, for months. So that's the kind of thing I'm concerned about. That's when what's going on in the stock market and the financial markets more broadly becomes a macroeconomic issue, and that's a risk. Now, I don't think that should be anyone's baseline forecast. It's not what I expect most likely to happen, but I do think that's a risk. And with each percentage point increase in the stock market on top of a 5-10 basis point increase in 10-year Treasury yields, I say that risk is rising and growing, and something that people should be prepared for.
Mark Zandi, Moody's Analytics Chief Economist. Thanks so much for joining us here this morning. Really appreciate it.
Yeah, anytime.
Thanks. We'll bring you full coverage on the tariff impact on autos and retailers as well throughout the show. But for right now, it's time for our stocks to watch. You can scan the QR code below to track the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. First up here, we're watching Dell and HP today. The company's quarterly results showing that the personal computer market, that PC market, is stalling. The revenue falling short of expectations. Both tech companies also issuing weak outlooks, but citing positive AI growth in the months ahead. Our own Brian Sozzi spoke to the HP CEO about the impact of potential tariffs, and here's what he had to say when asked if costs will have to be passed on to the consumer.
Some of that will have to go to consumers, given what is the overall margin that we have in the categories. But again, we need to wait and see what the final tariffs are for us to define what the exact plan is going to be.
And so, as we're hearing that from the HP CEO, I mean, it really does come with this broader backdrop of what type of relief we'll see soon in the PC market as well.
Yeah, and I think the big question here is exactly what that timing is going to look like. We're still clearly waiting for a pickup in PC demand. I think expectations going into this quarter were very high, not only for HP, but also for Dell. Enrique Lores also went on to say that the release of Microsoft's new edition of Windows software hasn't fueled the type of demand that maybe had been anticipated for this past quarter. So I think the current quarter right now, and looking ahead to 2025. That, of course, is going to be a real focus here for the street, for analysts, as they try to gauge what exactly demand, sales, and revenue are going to look like here in the coming months and coming quarters. And then you flip it over to Dell and talk about lofty expectations. That's a stock that was up more than 80% since the start of the year going into this quarter. You got the optimistic commentary coming out from the street ever since we heard from the results of Nvidia, saying that the setup here for some of these names is very strong, yet you're looking at a massive drop today. And that's also, that is just a reflection of some of that disappointment.
Yeah, still about 20% off of its highs. And even as it had been trying to, over the second half of this year, really kind of build up some momentum and rally back, it seems like this is going to be a step in the wrong direction. To your point, pre-market shares down 12%. However, there is some optimism on the call. And, you know, if I paraphrase Frank Sinatra and Snow showing no signs of stopping, they're saying AI demand shows no signs of stopping here on this call. That's what the company is talking about within its infrastructure solutions group, saying AI is a robust opportunity for us with no signs of slowing down.
Yeah, and something Michael Dell has told Brian Sozzi in the past as well. Well, coming up here on Morning Brief, we're going to count you down to the opening bell on Wall Street and bring you the latest on the impact of tariffs on retailers. We've got that for you next.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks during today's session with Yahoo Finance's trending tickers page. All right, first up, let's go to Workday here. Fourth quarter guidance falling short of expectations. Still, the software company beat estimates for the third quarter with revenue up 16% year over year. And the company's CEO also saying that they are looking to grow their business with the U.S. government. Shares right now down by about 12% here. And for investors out there that are trying to really wrap their heads around what may be taking place, I mean, this is also a time where the company has talked about where they're going to continue to spend and where they're going to continue to invest in their business. And so perhaps really kind of trying to pair that with what the analysts on the call might look at as the demand, perhaps just a little bit weaker than anticipated. There's still some positive in the headcount growth that they're anticipating to bring on, and then additional investments as at the same time as maintaining some of their cash flow operations and expectations next year of $2.35 billion.
Yeah, I think so much of this and much of the reaction that we are seeing is surrounding subscription demand and some of the disappointment there, especially when you look out to what the current demand is expected to be here in the fourth quarter. They're seeing 2.03 billion. The estimate was for 2.04 billion. So a bit of a disappointment disappointment there, or just shy of what the street had been anticipating. And that was called out a number of times within the analyst commentary that was out this morning. JP Morgan mentioned it. Piper Sandler, their analyst there, was saying that they downgraded the stock to neutral from overweight, highlighting the 10th consecutive quarter of slowing subscription growth. And when you take a look at the fact that the 12-month subscription backlog growth was near the guidance given, but it indicated no real improvement in demand, I think that's the key part of the story here and why we're seeing such pressure on the stock here this morning. Let's take a look at CrowdStrike issuing a weaker than expected fourth quarter earnings forecast. Still, though, third quarter revenue did beat expectations despite the cybersecurity company's faulty update that caused a massive IT outage around the world. That was just back in July. CrowdStrike's price target raised at Needham to 420 from 360, though you are seeing a bit of pressure here on shares this morning ahead of the open, off just about 1%. But I think any commentary, and this is what's really going to be key for analysts and for investors going forward, is just in terms of what that demand is going to look like. Lots of concern about the blowback, the backlash from the outage that they suffered in over the summer, and how that's going to affect not only attracting new customers, but retaining those that they have.
Yeah, to that point here, looking at some of the new annual recurring revenue here, there were some concerns that were actually raised over the decline in that annual recurring revenue, that ARR. And then additionally here, contraction that was pretty significant in the free cash flow margins as well. That's being talked about by analysts here this morning, and Scotiabank actually adjusting their price target on the name. They actually increased it, though, to $300 from the previous target of $265 here, maintaining, though, a sector perform rating on the company. Another trending ticker that we're watching today, Nordstrom beating third quarter estimates, boosted sales of women's apparel and activewear. Joining us now to break down all things Nordstrom plus the rest of this retail landscape that we've heard from this week, Dana Telsey, Telsey Advisory Group CEO and Chief Research Officer. Dana, great to have you here with us this morning. Just want to get your outlook as we kick off the busy holiday shopping season this weekend.
Well, thank you so much for having me. Yes, I think the outlook for the season, I think it'll be a respectable season. But really, we've seen it begin much earlier when Best Buy had their advertisements in September talking about the holiday season in September, coupled with the fact that you had Amazon, Walmart, and Target having their big days in October. And now, I don't know about you, but I'm getting emails flooding my inbox and texts of all the deals that are out there. With a compressed season, 5 fewer days between Thanksgiving and Christmas, the time is now to capture that consumer and convert. And you're right, what we've been seeing in earnings, Nordstrom was better than expected. You take a look at the acceleration that they had from the second quarter to the third quarter of women's apparel, men's apparel. They had terrific sell-through of brands like Veronica Beard and Vince. So newness works. You saw it in Abercrombie's results, who beat and raised, and even take a look at Gap, who showed improvement too.
Dana, then who is best positioned this holiday season, given some of the trends that you were just mentioning? I know you're positive on A&F, but what are some of the other names that you think are going to work this holiday season?
I think innovation and value is what works. I think companies like Birkenstock, check out the new closed-toed shoes. I think Ralph Lauren, who has a wider appeal to other age groups. I think Deckers, continuing with UGG and Hoka. I think that'll be a winner too. And value. Look at the off-pricers. TJX, whether it's their home goods concept or TJ Maxx. And you know what else? Take a look at Tapestry with the Coach brand. Their average unit retail selling price continues to increase. And the reason why? They've got newness and goods that people want.
Is newness enough for the resiliency narrative for the consumer to continue forward?
It is. Newness is what matters the most, but you know what? You need to marry it with something. Almost every retailer and brand has increased their marketing. Social media marketing is effective. The awareness is extensive. And I think marrying that with keen product is what boosts awareness and drives sell-through.
Dana, you just mentioned a Tapestry, just going back to the fact that they dropped the deal with Capri. How does that then set up, not so much Capri, but more Tapestry there for going ahead? Are they going to be able to continue to compete with some of those larger names?
I think they will. I think overall what happened is the fact that now Michael Kors is in a weakened state. It only continues to allow the Coach brand to gain share. And look what happened on the balance sheet side. The minute after the deal closed, they announced a significant share buyback program. So the balance sheet remains very strong. And now the focus is, if you have to say what needs to be improved, It's the Kate Spade business that we're watching very closely with the arrival of a new CEO.
You know, as we're thinking about the retail sector more broadly here, Macy's out with their preliminary results this week, plus disclosing an accounting error. As you're really looking through what those preliminary results spell out for this company, you know, what does the timeline look like for a revamped, a reinvigorated Macy's?
So you can call it a revamp, you can call it the new modern Macy's, the bold new chapter strategy that CEO Tony Spring is putting in place, definitely given his tenure at Bloomingdale's. Look what he's doing, looking to make a more differentiated Macy's that's out there. The November business picked up, and overall for retail, everyone was impacted by the warmer weather that took place during late September, picked up as the weather cooled and became more seasonal. That's a positive for Macy's also. So the revenues were essentially in line. Also, what you've seen is the Bloomingdale's business, the Bluemercury business has been solid, but everyone is impacted by that core customer who's being more careful with their dollars in that middle income type of stream. So I think you're going to see the level of promotions continue to be very carefully managed at Macy's in order to drive that sell-through. With the delivery expense accrual issue, they'll be reporting their full earnings sometime before or on December 11th. We're waiting to hear more there. It's a work in progress, and Tony, who's had such great success at Bloomingdale's, is bringing some of that insight and knowledge into Macy's in order to extend the reach.
Yeah, Dana, Macy's CEO was asked by our very own Brooke DePalma at our Invest conference just about the headwind of tariffs. That's been a common thread throughout this earnings season. We've heard a number of retailers starting to weigh in just a bit, and very much it seems to be uncertain, rightfully so, at this point. I'm curious how big of a challenge you view potential Trump tariffs being to the retail sector.
It's significant. While every retailer and brand has diversified their sourcing from China, you still have China exposure, and it continues the focus on being reduced. Whether it goes to Vietnam, whether it goes to South America, that is the focus. But it's a headwind. Look what the NRF put out, that it could impact consumer spending by nearly $80 billion and require apparel companies to raise their prices by a double-digit amount. It is a headwind. It's not good for the consumer because it causes prices to be raised. And also, for many, the ability to garner that expertise in manufacturing goods, is it just too expensive and we don't have it here in North America?
Just real quick, one word answer basically. Which company is the best positioned to outlast any tariff threats of the retail environment?
It's the off-pricers. The off-pricers always have a pricing umbrella that's below everyone else. They'll continue to be a share winner and a traffic gainer.
All right, Dana Telsey, always great to have you on. Thanks so much for taking the time to join us here and for your insight.
Thank you.
We appreciate it. Coming up, we've got the opening bell on Wall Street. We'll be right back.
All right, there you're taking a look at the opening bell at the New York Stock Exchange and at the Nasdaq. At the New York Stock Exchange, you've got Macy's Thanksgiving Day Parade, Santa and his elves, where there's never a delivery expense issue. They are ringing the opening bell at the NYSE, ticker symbol M. And at the Nasdaq, you've got MyPony.ai ringing the opening bell there. They've got some fun fetting. Pony.ai ringing the opening bell of the Nasdaq. All right, let's take a look at the major averages as we begin today's opening. There we go. All right, we're calibrating right now. Today's opening cross here, we got the Dow Jones Industrial Average opening higher by about 0.1%. We'll round that off to S&P 500 right now. You're seeing that open to the downside by about 0.1%, 0.2%, right in between there. And then the Nasdaq Composite, there we go, as that starts to calibrate here. I could have sworn I'd seen it lower in the futures here, so to my surprise there, earlier it was in the green. But anyway, right now it's down by about 0.3%. Let's take a look at some of the sector activity as we begin today's trading action. We've got 11 S&P 500 sectors up on the board for you. Technology is actually pulling up the caboose right now. XLK, that's down by about 0.9%. However, leading the pack, and we do have more leaders than laggards. Real estate is the best of the leaders. That's up by about 0.75% right now. And just before we toss it on over to Jared Blickery, I'll give you a quick look at the Nasdaq 100. You've got what seems like a lot of red on there. Looks like we've got more red than green as of right now in our Christmas themed and Christmas colored, of course, coloration and everything. Yahoo Finance's Jared Blickery has got more. I mean, Jared, it seems like we're always Christmas themed when you take it to the markets.
You bet, Brad. I want to go to the S&P 500 because we are in the midst, we are just camping out by these record highs. We printed one yesterday and right over the 6,000 level. It looks like this market is just looking for an excuse to head higher, but we don't have a lot of volume, admittedly, and we're not expecting a lot of volatility for the holidays, and I think traders will be just fine with that. I want to take a look at the US dollar index. This is falling by the most in 2 weeks. That is good news for stocks because the higher dollar was putting pressure on risk markets only a few days ago. So a little bit of a reprieve there. Also seeing a similar story in the 10-year T-note yield. We see rates now in the 10-year tenor about 4.26%, down 5 basis points. And we go back to the sector action. One of the things I was looking at, and by the way, we have 5 sectors that are at or near record highs. 5 closed at record highs yesterday, including discretionary. We also have industrials, financials, and 1 or 2 others. So it's just been a kind of nice to see this broadening out of the rally. Now today, tech is heading down, but not necessarily unprofitable tech. If we got time, I'm going to come back to that. But now I got to get to the futures because we are seeing coffee at the highest price, coffee futures, highest price since 1977. I'm going to show you a max chart. Now, this chart only goes back to about 2000, but in these 24, 25 years here that you're seeing, that is the highest price. So something to note for all you caffeine and coffee friends out there. Gold also has been under a little bit of pressure lately. Let's see if I can find GC equals F. It is up today by about 1%. Let's dial this down to a 3-month chart and we can see the vicissitudes here right back in basically the middle of its post-election trading range. So looks like there's a decision to be made there or not. We'll have to see what happens today. And then finally in crypto land, we have Bitcoin heading to 95,000. From the downside to the upside. So that's actually good news because there were some concerns that we were dropping below 90,000. That would have pointed to a potential false breakout and people concerned about another crypto winter. Well, guess what? We are heading north and we are almost at 95,000 once again. So good news for crypto fans. I just want to close here by showing you unprofitable tech. So the big cap tech today was under a bit of pressure, but we're seeing the opposite here in some of these smaller stocks. Shauna?
All right, Jared, thanks so much. Let's get to our chart of the day. Madison Mills standing by for a closer look at some hedging that you could see for a sell-off in treasuries. Maddie.
That's exactly right, Shauna. We're getting a bearish tone from traders in the interest rate options market in particular, as bond traders are starting to position themselves for a potential increase in U.S. Treasury yields moving forward. You can see here in this chart behind me, we're taking a look at this strong demand for put options from January and February contracts with positions targeting 10-year yields as high as 4.9%. moving into the new year here. That is well above the average yield, the current yield rather, which is around 4.3% last time I checked. And this year's high was just over 4.7. So getting up to 4.9 is going to be a really strong increase to the upside when it comes to those yields. So one of the reasons that we are seeing this bearish tone amongst Treasury options here is that Trump trade coming in here. The idea that some of those tariff policies that Trump has been touting this week in particular could lead to more inflation moving forward. And we did see a pickup in yields and a little bit of selling off in treasuries this week on the back of those announcements on tariffs here. We also have this morning Trump's USTR pick, Jameson Greer. He is a China hawk. He's very pro-tariffs. He also worked closely with Trump's former USTR head, Robert Lighthizer, who's in that same role under Trump 1.0. And Lighthizer was also very pro-tariffs and led the tariffs regime in Trump's first round as president. So an anticipation in the Treasury space of more of that to come here. Now, what could be the key kind of determining factor of Treasuries as we head into next year? That's going to be the jobs report coming up. We also have, of course, that key December Fed meeting. But heading into those next big catalysts for the Treasury space, JP Morgan had a client survey out showing that short positions are now at their highest in a month for the Treasury market. So this could be just one place to look as a potential pressure point for equities moving forward if we do see that move to 4.9 in the 10-year in particular, guys.
All right, really interesting chart there. Maddie, thanks so much. Appreciate it. Guys, coming up, we're talking Black Friday deals and holiday shopping with the CEO of JCPenney. Mark Rosen joins us next.
Start of the holiday shopping season kicking off this week with Black Friday, and expectations from retailers, well, they've been mixed so far. Target and Kohl's both sounding cautious with some of their weak forecasts. Others, though, like Nordstrom, Dick's Sporting Goods, and Abercrombie & Fitch, all raising their outlooks in anticipation of a, quote, successful holiday season. Here to discuss that and more, we want to bring in Mark Rosen. He's the CEO of JCPenney. Mark, it's great to have you. So I think investors are trying to figure out what exactly this holiday season is going to look like this year for some of these leading retailers. What are you expecting to see at JCPenney?
Yeah, thank you for having me this morning. We're actually really encouraged as we're going into the Black Friday weekend. Since back to school, we've seen a real change in trajectory in consumer traffic and in the sales trend in our business. I think a lot of that started when we relaunched our rewards program in the spring, and we now are going into holiday with twice the number of customers having our Cash Pass rewards in their pocket that they can spend during holiday. So we feel really positive about that. And we followed that up with our Thursday night football really big deals. Things like buy one towel, get two free that ran on a Friday, Saturday, Sunday, every weekend for 16 weeks of Thursday night football. Engagement ring, a single 1 carat solitaire engagement ring, any cut for $6.99, incredible values. And what we're seeing is that when we put those incredible values out there of great quality product for the customer, the traffic trend is strong and sales are strong with it.
Mark, we don't get the pleasure of hearing from JCPenney on a quarterly basis like we used to for years. And, you know, even as we're thinking about how so many companies are trying to navigate this environment, publicly traded companies, that we hear them on the earnings calls and we are able to read through some of the tea leaves within their earnings releases as well. We don't get that same opportunity. How is JCPenney doing right now? How is the business? Is it profitable? And what's the strategy been looking like in implementation?
Yeah, so Brad, like I said, we're really pleased with what we've seen since back to school and the customer trajectory and the improvement in the customer trend that we're seeing. With that Thursday night football campaign that I mentioned, we're expecting that by holiday, we're going to have about 2 million new customers in our database who are coming back, and about 15% of those have already shopped for a second visit. So we're focused right now on customers and customer traffic, and we're focused on really emphasizing the amazing value and the fashion that we have in our store. We're also really able right now, and that's one of the advantages of being private, able to focus on reinvesting in our business and the shopping experience that we have for our customers. And about a year and a half ago, we launched $1 billion self-funded reinvestment in the business, focused in the online shopping experience, the delivery experience, the in-store experience. We've remodeled about a fourth of our stores, about a quarter of the fleet is remodeled. And we're making lots of changes in our technology to make sure we have the right inventory for the customer in the right place. So being private right now has allowed us to invest in the business, and we're seeing the results of that in the change in customer trajectory and traffic.
Investing in the business, focusing on the consumer. If not profitable right now, then what is the timeline to that profitability?
So, you know, right now, like you said, we don't release our earnings, and so we don't necessarily talk about our profitability, but we have a path to profitability, and we are seeing very strong results in the business, and we're encouraged by what we're seeing in customer traffic, and we're encouraged by what we're seeing in the results.
Mark, going back to what you just said a few moments ago, just about the hunt here for value, is value more important than ever this holiday season?
I do think that value is more important than ever, but I think that the customers also changed their definition of value. In other words, value is not just about price. Value is about amazing fashion, unexpected fashion. It's about great quality products. So I think you can see behind me one of the examples of that outstanding fashion that customers are finding when they come into JCPenney, and it's an incredible value too. But customers are looking for something they're going to wear to the holiday party, and behind me, I don't think you can see the skirt, but there's a metallic Worthington pencil skirt that I think is $23.99. The faux fur jacket, you can see the third piece on top of that is our ryegrass faux fur jacket. It's $60. With the sweater, that whole holiday outfit is about $100. That's an incredible value for the customer, walking into holiday, feeling great, having amazing fashion, but also an unbelievable price. And I think it's that combination that they're looking for, and I think their definition of value has become broader. And that's what we're seeing as the customers really responding more to fashion.
Mark, what do you envision, especially as you're talking about some of the investments in technology, what do you envision as the role between the digital front where you're engaging with consumers versus the in-store, the brick and mortar, the JCPenney that Shauna, that many of our producers and team grew up going into and finding inspiration there versus in the digital realm? And how do you kind of make sure that you're engaging with that newer consumer that is spending more time in that digital realm?
Look, I think they're both incredibly important, and the customer is a lot of times starting out their journey in digital, and they're looking on social, and what we're seeing right now is a trend in social where customers are posting, back to what I was talking about with fashion, they're coming into our store, they're finding incredible fashion, and they're posting their JCPenney haul. We had a customer who posted on social, and she basically started out her social post by saying, "I'm shook by what I found at JCPenney. I can't believe what I found at JCPenney." And the trend out there in social is don't sleep on JCPenney. They're finding incredible product. She highlighted several things, but one of the things she highlighted was a ribbed tank top that she found. She was going into the mall. She was probably anticipating that she was going to go to specialty. She would have paid probably 3 times the price. She was able to get that tank top in 3 colors versus what she would have paid for 1 inside the mall. It's incredibly fashionable. It's great quality, and that younger customer's finding that. Now, if you come back to the store experience, I also think the store experience is incredibly important, and you talked about remembering going into the store when you were younger. I remember going in too, and there are things that you can only do in the store. My family used to go have our portrait taken at the JCPenney Portrait Studio, and so there are experiences in the store, like a mini makeover, a facial in our beauty department, like getting a cut and blowout in the salon, or like getting your family portrait taken, that you can only do in store. And so in store, we're really emphasizing that experience aspect.
Mark, before we let you go, just what is your assessment of the potential Trump tariffs that we could see specifically on your business? And are you doing anything at this point to try and mitigate those risks?
Yeah, we've heard a lot of talks about tariffs during the election season and beyond. And I think right now we're waiting to see what actually comes to fruition. It's not something that we've been waiting on, though. We've been, for a number of years, working to look at where we source our goods and the country of origin. One of the advantages we have is about 50% of our apparel is private label, meaning that we source that. And so we decide the country of origin where it's made. We've moved a lot of our goods to what we believe are going to be lower tariff countries. I am concerned, however, because there are certain goods that can only be made in countries like China. One of those categories that's relevant right now is Christmas ornaments and Christmas decor. Those lines are highly capital intensive and they're high cost to move. And so what I worry about is that there's going to be a higher cost of either moving that product or of the tariff. And my concern is that could mean higher prices for customers next Christmas season for those goods.
All right, Mark Rosen, who is the CEO of JCPenney. Mark, thanks so much for taking some time with us here this morning. Wishing you guys a happy holiday season over there for you and the team.
Thank you for having me. Happy Thanksgiving, and most of all, a happy Black Friday.
Well, 2024 has been a record year for air travel here in the U.S. The busiest day in TSA history was this July 7th, and that record could be beaten this week, with the TSA anticipating a record 18.3 million passengers to fly this week. That's a 6% increase from the same period a year ago. Joining us now with more on how this record demand will play out through the rest of the holiday travel season and into 2025, we got Steve Hafner, who is the Kayak CEO. Steve, great to have you back on Yahoo Finance with us. Just walk us into some of the booking trends that you're seeing and whether that has legs going even beyond the holiday season.
Sure, Brad. Thanks for having me back on. It is a record travel season. Demand remains strong across the U.S., especially for international destinations and especially for premium seating. So, I think Americans shouldn't be afraid of what they're going to experience in the airports. The airlines, the airports, and even the FAA have staffed up. And based on what I checked this morning, we're looking for a smooth travel day in terms of airline operations, unless you're going through Denver. So, if you have the unfortunate experience of going through that airport right now, you should prepare yourself for some delays.
Steve, what does pricing look like this holiday season?
It's down. So demand is strong. The airlines are full. They've done a great job with revenue management, but prices are down versus last year. So domestic prices are, according to Kayak data at least, down 6%. International is looking to be down more like 9%.
And With all this in mind, what do you kind of extrapolate from the booking data about the state of the consumer right now and what they're prioritizing, especially as it seems like there's more of a prioritization from the air travel companies on premium right now?
There's definitely a lot of focus on premium pricing because they've got these teaser rates called basic economy, at least for the airlines, to try to get people to think about and get in the mindset of traveling. And then, of course, they'll try to upsell you to a better value, which is premium cabins. But I think overall, as you see with airfares and even with rental car rates and hotel rates, prices are down, which tells you that demand is on margin a little bit down too. And travel suppliers are responding by cutting price to ensure that their hotels and planes and rental cars stay booked. So if you're in the mood to travel, you're getting a better deal this year than last year.
Steve, what about for the procrastinators out there? Is it too late to book holiday travel at this point, or where are some of those opportunities?
It's not too late. It's probably too late for Thanksgiving. So if you want to go somewhere, you might want to get
that would be a quick turnaround.
But tomorrow actually is the cheapest day over Thanksgiving to travel by plane. So if you can find a flight tomorrow, please book it. But if you're looking for deals over the holidays, now people are already starting to shift and think about Christmas and New Year's. According to Kayak data, prices are even lower there than they are for Thanksgiving in terms of year-over-year declines. And if you have some flexibility with your travel plans, you can use our Explore tool, put in destinations you're thinking about and a time frame or trip length and a budget, and we'll show you what your options might be.
Traveling on the day of Thanksgiving or on any holiday is some real main character energy. I'm not sure I got that in me, Steve. Just as you think more broadly about some of the trends going into next year, is the pricing power that some of the air travel companies have been able to put out there and in trying to make sure that they're eliciting even more of that spend from customers, whether that be in the share of cabin or whether that be in the perks that they're offering. How do you see those continuing to be opted into by consumers, especially if they're pushing back on price in certain elements of travel right now?
Well, look, the two carriers who are doing the best job at splitting fares into bundles, if you will, are United and Delta. They had the lion's share of the industry profits, so everyone's trying to catch up as quickly as they can. So think American, think Southwest, even think the newly bankrupt Spirit Airlines. Everyone's trying to copy their business model. And I think what that approach is working. It's working quite well, and they're going to continue to push the envelope of differentiating a seat from the amenities around it and from other in-airport amenities as well, or services. So, at Kayak, we're trying very hard to keep up with this because it's a lot easier to just compare prices than it is to compare a bundled offer of seat selection, baggage check-in, priority boarding, lounge experience, flexibility. It gets very complicated very quickly.
Do you see the absence of Spirit raising prices?
I don't, because for the moment, at least, Spirit continues to fly. Their operations are unaffected by the bankruptcy proceedings. As they try to get more financing, they'll, I suspect, be able to catch up to some of the other carriers. They might have a slightly smaller fleet over time, but I think it'll be a better flying experience for people, and I think they'll still continue to exert downward pressure on prices.
Steve Hafner, CEO of Kayak, thanks so much.
Thanks, Shana.
Coming up, Apple falling behind the competition in the global smartphone sales rebound. We've got the details for you next.
We're taking a closer look at some trending tickers this morning, doing it in 30 seconds each. Let's go. First up, Apple falling behind competitors in a global smartphone sales rebound. Worldwide smartphone shipments are forecasted to grow 6.2% from last year. That's following 2 years of steep declines. This is according to market tracker IDC. But iPhone sales are expected to grow only 0.4%. There you're taking a look at shares of Apple on your screen, down right now today. And then over the course of this year as well, you'll remember that Apple is up by about 25%.
All right, let's take a look at Starbucks. Starbucks workers are only getting 60% of their overall bonuses for the fiscal year ended in September. That's according to a report out from Bloomberg. This is apparently due to the company's lackluster financial performance, something that has been followed so closely by our Brooke DePalma here. I also want to point out it's been a tough time for Starbucks. As you look ahead to 2025, it might still continue to be challenging. You've got coffee prices at the highest level that we've seen since the 70s.
Yikes. All right, finally, Urban Outfitters getting some love from analysts this morning after an earnings beat. Citi raising the stock to a buy from neutral. Barclays, JP Morgan, and Jefferies all lifting their price targets. And the company's third quarter sales growth surpassed Wall Street expectations. Shares are up 12% for the good Philadelphia-based company.
There we go. Well, that does it for Morning Brief. Keep it right here. We've got Catalyst coming up next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capsule Gains. We're off for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get a look at the three catalysts that we're watching this hour.
First up, a fresh read on the Fed's preferred inflation gauge is crossing the wire now. We'll get you those numbers.
Plus, we'll bring you the latest consumer spending data and push ahead to Small Business Saturday.
And as Trump's economic team takes shape, we'll speak with Mick Mulvaney, who's Trump's former chief of staff, about what it means for the future of the economy.
We have some breaking economic data crossing the wires right now. Let's take a look at the October PCE numbers. Remember, this is the Fed's preferred inflation gauge. For the month of October, you're looking at the PCE index rising 0.2% on a month-over-month basis, in line with expectations. Actually in line with expectations across the board here when you take a look at these numbers. The year-over-year rise was at 2.3%. When you drill down into the core readings that we're getting, core PCE index on a month-over-month basis, we saw prices rise 0.3%, again in line with what the street had been expecting. And when you take a look at that year-over-year increase in core PCE prices rising 2.8%, that was directly in line with what the street was looking for. So matching of expectations across the board, very much what the street had been anticipating that we would see here from this print. But again, it shows that inflationary pressures still remain, although not too much to the upside, where it raises some concern at this point.
Yeah, absolutely, Shauna. We'll definitely get into those numbers a little bit more, but I want to break down personal income and personal spending data for the month of October. Starting off with personal income coming in here, the survey is coming in at 0.3%, but the actual number was 0.6%. So a little bit of a beat to the upside there. The prior number was 0.3%, so also a beat in comparison with that prior number as well. We also have personal spending coming bang in line with the survey at 0.4%. The prior month was at 0.5% previously, but was revised up to 0.6%. So a little bit of a decline in that personal spending, but a beat to the upside when it comes to that personal income. So it's going to be interesting to see whether or not that plays into the spending patterns that we're seeing from consumers moving forward. But I think that PCE data is the data to watch this morning. So we're going to talk a little bit more about that data and how it could impact the Fed's next policy decision. We're going to bring in Paul Grunewald. He is the global chief economist at S&P Global Ratings. Paul, it's great to have you in studio with us here. So that tick to the upside in that core PCE, what stands out to you?
Yeah, well, the core PCE has been going sideways for the last couple of months, and if you think the Fed is on a declining rate path, which we do, that's probably leaning toward the pause camp. We know the target is 2, and they're trying to get there gradually, but this underscores the message that the Fed knows policy is restrictive, but they're not going to be in a hurry to cut rates unless they see, a more convincing decline in the core PCE. Looks like it's, as I said, going sideways for now.
Paul, I guess what's necessary then to see further improvement?
Yeah, well, I think the economy is still running a bit hot, right? We got a confirmation of Q3 this morning at 2.8, and the first half of the year was closer to 3. The tracker for Q4 is above 2.5. So even with our upwardly revised speed limit, the U.S. now seems to be a 2.25 economy rather than a 2 economy. We're still running a bit hot, so we the result of that is we're going to have inflation higher than target. So the Fed's going to keep the foot on the brake and keep rates tighter for longer.
Paul, do you think when we look ahead to the changing of the guard in the White House, I guess when you take into account Trump policies, do you think the growth that we have been seeing, is that sustainable? Or I guess what are your expectations?
Yeah, well, I mean, it's been surprising, right? This resilience has been really surprising. If the estimates are right, we do need to slow down a bit. But a lot of the policies that are on the board strike us as inflationary, right? If you start putting tariffs and raising import prices, that's inflationary. If you want to do a little bit more juice on the tax cutting side, that's inflationary. Reducing the labor supply through deportation is going to put upward pressure on wages. That's inflationary. So if anything, what's on the table right now, when we're not really sure what happens in terms of actual policy, all of that's pointing to more inflation pressures and perhaps a Fed that needs to go even slower on the rate cuts.
Do you think they will end up doing that, or will they potentially be concerned about looking political in response to those policies?
One thing we've been watching very closely is the Fed funds future, where the market thinks the Fed's going to be about a year from now. We just put out a report this morning for our quarterly credit conditions. I put a chart in there 2 months ago, less than 2 months ago, at the end of September. The market thought the Fed funds rate would be at 2.9 a year from now. That's gone up to 4. So the market thinks the Fed's going to stop 100 basis points higher, and the long end of the curve is higher, right? 10-year treasuries have come up as well, and as a result, the dollar is stronger. So the market, even though we don't have full certainty about the policy mix under the new Trump administration, pushing to higher inflation, higher rates,
Is that dollar strength that you mentioned enough to fight off inflation?
Well, the U.S. isn't a particularly open economy, right? So it will reduce import prices, but I don't think, we're not a sort of textbook small economy that trades a lot. So probably not. It will help a bit. You're right.
Paul, how does the Fed then walk that fine line?
Well, that is a fine line, because we've been saying that we got inflation down close to target. We're going to start taking our foot off of the brake, but now we've got a potential new policy package that's going to juice up the economy again. There's a little bit of a disconnect between where the economy actually is and kind of where the new administration seems to think it is. If you've got an economy that's running a bit hot, inflation's a bit high, the Fed's got its foot on the brake trying to take it off. You don't want to juice up that economy with more demand, right? You want to kind of glide it down to the path. We'll see if this all plays out, but the U.S. is still doing much better than the rest of the world. Productivity is strong, new business formation is strong, growth is strong. That's why we have a strong currency, strong growth and higher interest rates, and nothing we see in the near future is going to change that.
Just to get a little granular on this data here, I'm interested in your thoughts on that personal income number coming in at 0.6% above that 0.3% estimate. That seems like a hefty thing, because if we're making more money, we're going to be spending more, we're going to make the inflation.
And that kind of nexus, this nexus between a strong labor market and strong consumer spending and incomes kind of recovering after that initial burst of inflation, that doesn't seem to be moving too much. And again, it gets back to this resilience thing. We had a big rise in interest rates. We thought the economy would slow. But the U.S. economy is also kind of going sideways. We seem to be in this 2.5% to 3% range, which is faster than the supposed speed limit. We've got high inflation. All that says rates are going to have to stay higher for longer.
And I asked this to Mark Zandi earlier, and I'm curious to get your perspective on it, just the defining element almost of the economy here as you look ahead to 2025. Is it more about Trump policy and what we're going to see coming out of the White House, or is it more about Fed policy, I guess Fed's reaction to some of those data points?
Well, the Fed is going to look at the economy and inflation pressures and react. I mean, the driving force is going to be Trump policies. And again, the economy is in a pretty good spot right now, both from a cyclical position and relative to the rest of the world. So you don't really want to mess with that too much, right? If we've got 4% unemployment, growth is kind of 2.5%, inflation's coming down. I wouldn't want to rock the boat too much in that scenario, but we'll have to see. I think we've got a lot of volatility ahead. I think that's kind of a given in the next 4 years.
All right, Paul Grunwald, always great to have you here on Yahoo
My
Finance.
pleasure, ladies.
Thanks so much for taking the time. It's time now for our trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. You can do it all at Yahoo Finance's trending tickers page. First up, let's take a look at Autodesk here. The shares are on the move following its third quarter earnings here, beating the street's expectations, but the outlook failing to impress Wall Street, even as it raised the low end of its previous guidance. The design software company also appointing a new CFO, which is effective next month. You're taking a look at the stock, taking a pretty significant hit at this point, off just about 5.5%. Again, much of this reaction that we're seeing this morning was to the guidance that we are getting, because it did largely top the street's expectations. Look at the quick reaction that we are getting from the street this morning. Citi saying that they believe guidance may reflect some conservatism with the ongoing transition of the new CFO. So that's important to keep in mind as you're trying to gauge what some of that momentum is going to look like beyond maybe the next quarter or two. But they did say that they are underwhelmed by the more modest profitability profitability outperformance. So again, the stock has been able to regain some of its momentum ahead of these results. You were looking at year-to-date gains, it looks like of just over 20%. But again, we are seeing some pressure on the stock this morning, a lot of that because of the guidance.
And we did see strong third quarter performance despite that lack of lift to the upside on that guidance. They showed an 11% year-over-year increase in their revenues here. So we got a note from BMO Capital Markets this morning talking about their market perform rating, maintaining that rating on shares of Autodesk, but increasing their price target to 308 up from 287. They talk about how they do see a lift off of that new CFO hiring, like you mentioned, Shauna, and they say that's going to be a critical part of the executive planning and financial planning for Autodesk moving forward here. They also talked about how the company's underlying performance does remain strong if you look under the hood of the data in their latest print, and they continue to focus on new projects like Fusion. That was also highlighted as part of their progress story on the call here. So it's going to be interesting to see whether or not that trajectory can be enough to justify this price target increase over at BMO this morning.
Yes, and we will be speaking about this and more. Autodesk CEO Andrew Anagnost, he will join us on Monday right here on Catalysts.
And next, we are watching crypto stocks today. We've got Coinbase and MicroStrategy climbing as Bitcoin resumes its climb towards $100,000. It's been really interesting to see the moves in Bitcoin this week, kind of mirroring a little bit of what I talked about earlier in your 9 a.m. hour, just in terms of the volatility of the Trump trade. We saw Bitcoin coming off its highs earlier this week. Now it's moving to the upside and bringing these crypto stocks right along with it. I just want to see if I can pull up Bitcoin for today. The latest numbers that I've got on my end is a little bit delayed for me here, but it's up about 3% on the day, just above 94,000. So getting further and further from that $100,000 mark, but we certainly are still seeing a lift to the upside when it comes to Bitcoin over the past week here. Having said that, that volatility that I mentioned is going to be really important to watch for a company like MicroStrategy. They lost about $30 billion amid that drop in Bitcoin over the past couple of days here, just because they are so leveraged to that asset.
Yeah, and I think the big question is whether or not we need a specific catalyst to get above that $100,000 hump, and then exactly what the activity is going to look like. And Maddie, you're so right when it comes to volatility. Obviously, it's hard to talk about Bitcoin without mentioning the volatility largely associated with it. And there's been a number of our guests that have come on over the last several weeks just talking about and really warning that we could see a sell the news type of event if we were to cross 100,000. We've already seen a bit of a sell the news event as we got closer to that level. So again, that is a key thing to watch here. And Riot's CEO was very much talking about the fact that there's a lot to be optimistic about, especially when you take into account some of the initiatives or early talk that we are getting from the incoming Trump administration, the potential appointment here of a crypto czar, and what exactly how that would play out here over the next 4 years. And that, of course, has been the driving factor of this recent euphoria and optimism surrounding Bitcoin, talking about a more friendly or what is viewed as likely to be a more friendly administration towards the industry.
Absolutely.
Let's take a look at some of today's market headlines to start the hour. This is sponsored by Tasty Trade. The major averages here on the move on this holiday shortened week. You're still looking at a mixed picture. You got the Dow up just shy of 100 points, but you got the S&P off about 0.1%, the Nasdaq off about 0.6%. Flipping over to the bond market, some activity here on the heels of that PCE print that we did get out this morning, although not a huge change. We could throw up the bond market here. Can we get that, guys? All right, here we go. The 10-year yield, you're looking at some pressure here, but the yield's off just about 5 basis points. You got the 10-year right around 4.26. You're seeing some pressure here across the board for yields. All right, coming up, the financial health of the holiday shopper. We're breaking down the state of retail next on Catalysts. Fresh inflation data out today, calling into question the Fed's next move with the decision just 3 weeks away. We want to bring in Elias Sabo. He is the Compass Diversified CEO. Elias, it's great to have you here on Yahoo Finance. And for those who maybe aren't familiar with Compass Diversified, many have referred to you as almost a mini Berkshire. You're giving investors access to some of those middle market companies. I'm curious, as we do take a step back here towards the end of the year, just what is your assessment of where things stand within the economy today?
Yeah. First, thank you for having me on, and happy Thanksgiving to you and your viewers. We've seen all year the economy has been really strong, much stronger than our anticipation going in. About 70% of our portfolio is driven by consumer, and the consumer has stayed remarkably strong throughout this entire year. We've seen a little bit of an acceleration actually in the last few weeks in post-election, and it's broadened out. For most of the year, we saw the most affluent consumer that was still spending, but now we're seeing pretty much all cohorts within the consumer spending really strongly. So we expect this to be a pretty good holiday season and finish out what has been a pretty strong year.
How do you anticipate the incoming administration impacting that consumer spending, particularly given some of the policy positions around tariffs that could lead to more inflation and higher prices for consumers?
Yeah, Madison, it's a real unknown what's going to happen. I would say because this administration had been in office 4 years ago and there was a lot of tough policy rhetoric on trade and China, we, in particular at Compass diversified our supply chain, and we moved to have backup sources so that if tariffs are implemented, which look to be quite draconian from what is being said right now in China, we have other countries that we can move our supply production to. That notwithstanding, there is going to be some inflationary pressures unless the dollar can strengthen enough or tax changes and, can come down enough to offset some of that. And we have the ability through our suppliers or through our own margins to be able to absorb some of that. But it is a great uncertainty. And I think if inflation comes back because of it, consumer spending will likely take a bit of a drop.
Elias, there certainly has been more and more talk that maybe the Fed is going to be on pause, whether or not that's at this upcoming meeting next month or whether or not that's into 2025. I'm curious, what does that mean for your business?
Yeah, rates are important for our business. Obviously, we are, and we compete, I should say, against private equity firms for the same type of assets. So we're buying these smaller middle market, innovative and disruptive consumer and industrial technology businesses. Generally asset prices are tied to interest rates. And as rates have come down, you have seen more activity in the M&A markets. We would expect multiples for these companies to go up slightly as a result. But more than anything, I think the pause in interest rates going higher and now a steadying with a slight decrease has allowed that change in financial conditions has allowed for some activity to come back to the market. In the last 2 years, it has been the slowest deal activity that we've seen in over 25 years of doing private equity investing. And we think now, and what we're hearing from all of our investment banking partners and other people involved in this, is that pitch activity has really picked up, and we would expect 25, because interest rates are steady to coming down a little bit, for M&A to pick up pretty considerably. So I think if rates can at least stay on this trajectory, maybe soften a little bit, it would feel like M&A activity should pick up, which will help our business.
How much do you anticipate the incoming administration, again, impacting that dynamic with M&A activity moving forward, given that there's kind of this idea out there that this administration is going to be a bit less hawkish when it comes to regulation of those kinds of deals?
Yeah, Madison, our companies that we purchase are typically much smaller and they don't get nearly as much FTC scrutiny. So it hasn't been as big of an impact for us. That being said, the current administration has a stance that mergers and acquisitions, especially if you are consolidating in an industry, is generally bad. So I think there's going to be a big relief. This administration prior had showed that M&A was something that they were in favor of, and the FTC was not active at all. So we would anticipate that a lot of the larger strategics will become much more active, and that creates a great environment when we seek to divest any of our businesses.
Elias Sabo, great to have you here on Yahoo Finance. Thanks so much for taking the time. CEO of Compass Diversified. Have a very happy Thanksgiving. Turning now to retail as the holiday shopping season gets underway. For a closer look at the health of the consumer, we want to bring in Steve Asada. He's a senior advisor to MasterCard, former chairman and CEO of Saks. And Steve, it's great to have you back here with us. So talk to me, I guess, what is the number one thing that you're watching for this holiday season?
Well, I'm looking at the consumer in general and how well they're holding up during this environment and their shopping behavior. So it's a combination of, first, I want to see how the sales come in over the next several weeks, and we're hitting into the peak of the season. And then ultimately, I want to understand what kind of margins we're going to get out of the businesses. And we won't know that until we see the earnings report later in the season. But overall, coming into it right now, as we hit the heart of the season and Black Friday this weekend, I'm looking to see whether or not the holiday forecasts hold up the way that they should hold up. And, you know, we're talking about the insights from the MasterCard Spending Pulse data, and that's projecting a 3.2% increase for the holiday season. Black Friday is only a couple of days away, and this is going to be an important one. We're seeing a lot of mixed results out of retailers during the third quarter. And the last couple of weeks, we're hearing a lot of favorable comments about early November. So this is our Super Bowl time. So I'm looking to see what happens in the next couple of weeks.
Certainly is retail's Super Bowl time. Steve, you mentioned the question of whether or not the consumer is going to hold up this holiday season. I guess from the indications of what you've seen within your survey, where do you expect to see that strength?
Well, I think overall, you see a consumer that's healthy. If you look at that 3.2% forecast, that's real growth in the range of about 2.5%. Inflation for those goods is in the 0.7% range for the forecast. I think you're seeing it across a wide range of categories. I'd start with online. If we're looking at online sales, it's forecast to be in the 7% range. Stores closer to the 2% type of range. If you go back to the pre-pandemic period, internet sales were growing at about twice the rate of in-store sales. We had a big bifurcation during the early pandemic when obviously internet took off, and then you had a reversion where stores were stronger later after the pandemic. Now we're into a back to the norm where the internet is growing faster than stores. So I'd start with internet sales. And those companies that have a very good omni-channel presence, obviously the digital-only superpowers, those are going to, I think I'd be looking at those, but internet is the first place I'd go to. The next I would look at is apparel. Apparel's interesting. They've had some sort of very low single-digit growth during the last several months. The forecast will be for a pretty strong apparel season, especially online, over the next several weeks. And you're seeing a lot of promotions going on out there. And this is a category where you have winners and losers. And so there's a real bifurcation going on, but I would expect apparel to perform strong. Electronics is an interesting one. We're going to see some good growth in electronics. You have a replacement cycle that's starting to take place. You're getting into the heavier promotional period. You see a lot of the ads out there right now for Black Friday and electronics. I would expect to see a good electronics period. I think you'll continue to see some very good jewelry performance. This is a gifting time. Gen Z, millennials are purchasing at a heavier rate in jewelry. I'd expect to see a good jewelry season. And I'm continuing to see a good performance. Restaurants, the high-end consumer is holding up well. So higher-end restaurants have shown very well over the last period of time. I'd expect to see that continue. That's just a flavor for some of the categories.
Steve, how should investors be sussing out the good from the bad when it comes to retailers? Because we've seen a really mixed quarter. We've seen it time and time again since we came out of the depths of the pandemic, this idea that you've got some strong performers, the likes of Urban, surprising to the upside because of their resilient spending in their more expensive brands. And then you've got a Target, a kind of middle income consumer brand, continuing to struggle. What's the rubric investors should be using to suss out those brands?
That's the $20,000 question, and it's most important question. I'm not going to talk individual companies. I'll talk to what I see as some of the trends. The consumer, one of the CEOs has talked about a choiceful consumer. Clearly, that's the case. Value, convenience is driving behavior, and the consumer's smart. They have perfect information online. They're able to look at pricing, and value is an important component. So, especially if you're not selling differentiated product, price is going to become the lowest common denominator. I think the next factor is going to be some of the membership. The companies that are offering memberships because people are affiliating and with organizations, and that drives value. So the companies that have these membership programs, I'm seeing a lot of those outperforming. I'm seeing outperformance in areas like off-price retail, and that's obviously very big in the apparel space. That ties back to the value equation relative to what consumers are looking for. Newness and fashion has always been a driver, and a lot of the brands that you're mentioning are winning on the basis of fashion. So you've got hot brands that are offering a twist on the fashion. That's important. In the food category, food is very, very important, and offering value within food, within the restaurant space. I see the high end continuing to perform well, but so in some cases, the lower end is doing well, especially when they're providing value meals. I see the middle getting squeezed in a lot of categories. I see that in apparel. I see it in the food area, and I see it across most categories. The middle is a difficult place to be. The high-end consumer continues to be very strong. When I was running Saks, we always used to talk about the relationship between the R-square of the stock market and the health of the luxury consumer. Luxury consumer has the resources. It's a question of how they're spending. They're very focused on experiences. They bought a lot of stuff during the pandemic. So again, if differentiated product, hot brands they'll be buying, but they're also very focused on experiences and travel in this environment. That gives you a sense of some of how I would bifurcate winners and losers. Anyone who's just focusing on non-differentiated product really has to think in terms of how do they win relative to either price or experience in a store.
All right, Steve, we got to leave it there. Thank you so much for joining us this morning. Senior advisor over at MasterCard. Thank you.
Thanks.
Coming up, we're going to get a read through on expectations for small businesses ahead of the busy shopping weekend, and we'll push ahead to Small Business Saturday. That's coming up next right here on Catalysts.
Consumer spending remaining strong, accelerating 3.5% in the third quarter. This coming as consumer confidence also improved in November, hitting its highest level in over a year. The improving data coming ahead of the critical Black Friday shopping weekend and Small Business Saturday. Here with more, we want to bring in Isabel Casillas Guzman. She's the administrator of the U.S. Small Business Administration. And Administrator Guzman, it's great to have you here on Yahoo Finance. Thanks so much for taking the time. I'm curious what you're hearing from small business owners at this stage of the economic cycle. Are they seeing an uptick in consumer spending?
Well, thank you so much for having me. It's a pleasure to be here as well. And, we know this holiday season in particular is the most critical for small businesses. And of course, customers walking in their doors is the most important factor for so many small businesses across Main Streets. And so they're very excited about the uptick that they're expecting with Small Business Saturday. We've always seen incredible performance during Small Business Saturday, the Saturday after Thanksgiving, where consumers come out to gift big and shop local, which is our theme this year. And truly for small business owners, when you contribute and buy your presence locally, you are contributing to local economies where they're creating jobs locally. And so I see a lot of hope in terms of what this season can bring to small business owners to cap out their year strong.
What have some of their concerns been, kind of to piggyback off of Shauna's question at the top there? What have small business owners been saying just about the state of this economic cycle? Because it's been a bit confusing. There's been this record-breaking inflation combined with record consumer spending, but also the vibe session at the same time. What clarity are you getting from small business owners?
Well, I mean, look, over the past several years, we've come from the worst economic crisis since the Great Depression to the strongest economy in the world. And, despite the 16 million jobs created, which they were a large part of, an economic growth at over 12% during President Biden's term, the strong consumer spending, they've had to face challenges, whether that was early on supply chain issues, inflationary pressures, you name it, workforce challenges. They've had to overcome quite a bit to be resilient. And so, clearly, they're still seeing consumers walk in their door. They're still seeing these, purchase orders come in as we make these historic investments in America. So we hope that, small businesses will see a strong season as well to carry them through this year. But as you said, it's been, one of the key factors that they need to look at is this consumer spending, the fact that incomes are up by $4,000 as well per year. And so truly relying on that ability for our consumers to continue to carry our economy. It's what powered the GDP numbers this morning as well.
Is there a risk that the potential tariffs that the incoming Trump administration has floated, could that potentially bring a lot of this momentum that you've been talking about just to a screeching halt?
Look, there's still a lot of uncertainty. I would say that, hopefully we'll continue to see strong economic growth. There's a strong foundation that we've built over the last 4 years, especially when it comes to small businesses. Thanks to the fact that our interest rates have dropped more, cost of capital is more affordable for small businesses. We've seen record financings at the SBA, especially small dollar loans. Those are businesses investing in themselves, investing in employees. So we need to continue on this course and build stronger.
Another policy that we're taking a look at in the incoming administration is immigration policy. And I wonder what you're hearing from small business owners about what that impact could look like and how they're potentially positioning around that.
Well, fluctuations in the workforce clearly affect our small business owners dramatically. They create 2/3 of net new jobs. They employ nearly half the private workforce. And so as cost of labor it goes up, clearly it affects their businesses. And so immigration is a key part of that. And so they continue to need a skilled workforce. They continue to need affordable workforce. And so, really, as we look towards the future and small businesses' ability to continue to compete, this will become an important issue.
Administrator Guzman, thank you so much for joining us this morning. We appreciate it.
My pleasure. Thank you. And don't forget to shop small this season.
There you go. All right. Small Business Saturday is coming up, folks, as we head into that Thanksgiving holiday. And coming up, we're going to switch gears a little bit. We're going to talk with former Trump acting chief of staff Mick Mulvaney on the latest additions to the president's cabinet. More on that when we come back. Billionaire Elon Musk calling for the elimination of the Consumer Financial Protection Bureau on X, writing, quote, "There are too many duplicative regulatory agencies." He is also giving us insight into plans for his Department of Government Efficiency with that comment. So joining us more to discuss, we've got Mick Mulvaney. He is former acting White House Chief of Staff under President Trump and Actim Strategic Advisors co-chair, also former director of the Consumer Financial Protection Bureau. Mick, it's great to have you on. Thank you for making time with us. Just want to get your reaction to that commentary from Trump, obviously as former director of the CFPB, but also you were critical of the organization. Do you agree?
I do. In fact, we examined the possibility of whether or not I had the authority to shut down the agency. The lawyers that I had hired actually told me that I could not, and I respected that decision. They did, however, suggest that the President of the United States might have the ability to do that. So the extent that Elon Musk and Vivek Ramaswamy and also Russ Vought, the designee for OMB, can shed some light on this, I think it would be extraordinarily helpful and very provocative.
Why would it be so helpful?
Elon's comments are right on point. If I wanted to be as gracious to Elizabeth Warren as I possibly could be, I'd give her credit for at least the idea of trying to centralize consumer financial protection into one agency, to sort of take the regulatory oversight authority as it deals with consumers from the half a dozen so federal regulators and centralize those to the CFPB. That never happened. What happened was we simply got a duplicative layer of additional regulatory oversight into the consumer financial protection relationship. So to the extent we're trying to bring efficiencies to the system, either letting the CFPB do what it was supposed to do and take that authority away from others, which is never going to happen, or shutting the CFPB, I'm all in for shutting the CFPB.
So, Mick, you don't think there's any risk just in terms of the fact if we do see this dismantled that it's going to weaken consumer protections at all?
I mean, show me what regulation couldn't take place, what protection wouldn't exist elsewhere. I mean, that's my whole concern. Again, if I wanted to give credit, it would be the idea of one-stop shopping for regulation is a great idea. They do it in Europe, they do it in Asia. We don't do it here. If you're dealing with consumers, I think it's 6 different federal regulators you have to deal with. If what DOGE, the Department of Government Efficiency, which doesn't really exist yet, is talking about doing is centralizing things, I'm all for that.
How effective do you think that Department of Government Efficiency is going to be? And how effective do you think Elon Musk will be in getting his desires like this dismantling of the CFPB through during this administration?
Yeah, one of the weaknesses of this department is that it isn't real. It doesn't exist. It's not statutory. It's essentially a PR campaign right now. It has 0 statutory authority. That being said, it's going to have a tremendous amount of visibility. We tried to restructure the government back in 2018 and failed in large part because we weren't able to sort of build public interest in fixing a bureaucracy that has pretty much, grown stale over the last 100 years since the modern bureaucracy was created during the New Deal. If Elon Musk and Vivek Ramaswamy can shed new light on it and get people interested in fixing the bureaucracy, that will be great. It won't have the authority to do that. OMB, the Office of Management Budget, will have some, but the DOGE will also rely on Congress to pass laws to change civil service rules. So it's going to be an all-of-government effort, but I think that it's got more momentum now than it did back in 2018.
I guess what makes you more optimistic that it does have more momentum now? Because I know you were in charge of government restructuring. It proved to be a very tough job. So why should we be a bit more optimistic at this point?
The debt. I think, to the extent people really, more and more people at least say they are caring about the debt. I don't believe it yet. I don't believe what people say in Washington. I believe what they do. So we'll see what happens if the new Republican-controlled Congress actually reduces spending. They did not do that, by the way, the last time they were in charge in 2017 and 18. But at least it feels a little bit different with more people pointing to the debt as a problem. So that's why I'm a little bit more optimistic that maybe they have a better chance. Plus, Elon Musk is just smarter than I am. So where I wasn't able to do something, maybe he can figure out ways to get stuff done.
Mick, how long do you think Elon Musk is going to last in the administration?
Oh, I don't know. It's a question that I get a lot. I don't know. I don't care. I don't care how long somebody's there. I care what they do while they are there. And if he can succeed in this, that would be a huge benefit. If that takes 6 months, if it takes all 4 years. But you got to think that this administration, at least generally, is looking at the calendar in two different pieces. The first 2 years, when they know or expect they'll continue to have control of both the House and the Senate, and in the second 2 years, where there's a chance that that won't be the case. So I think you're going to see an absolute flurry of activity on the legislative front here in the first 2 years. So does that answer your question? Maybe the over-under on how long Elon stays is 2 years.
Okay, well, let's talk about some other folks who are going to be surrounding Trump in the years to come. We've got some additions to Trump's economic team, Trump choosing Kevin Hassett as the director of the White House National Economic Council, also Jamison Greer as U.S. Trade Representative. And Greer, as you know, has advocated for what he calls a strategic decoupling of U.S.-China trade relations earlier this year, saying it could cause short-term pain, but the cost of doing nothing or underestimating the threat posed by China is far greater. And this is interesting in the context of the market action we saw yesterday, Mick, hitting another all-time high off the back of Trump's tariff announcement. This idea in Wall Street being that these tariffs are a negotiation tactic, they may not be as bad as Trump has said previously. Is that the belief in Washington?
A variety of different answers to a variety of different questions. As regard the tariffs and the impacts on the market, I think unequivocally you could, on a static sort of perspective, you could say, look, the tariffs are going to be bad for the economy because it will raise costs. And that's mostly true. It's not going to be a linear sort of connection between the tariffs on, say, Chinese good and the prices that consumers pay, because you can substitute other goods, substitute other producers, et cetera. But generally speaking, I think when the market is looking at the Trump economic team and saying, you know what, okay, tariffs are probably going up and that'll be a drag. Not as bad of a drag as some people say, but still a drag. It will generate a little bit of revenue, but not enough to make a difference on the debt. But then they also look into the bigger pieces of the puzzle, the regulatory environment and the tax environment. And I think they're sort of saying what the market is telling us is, all things considered, the Trump administration is going to be better for business than the Biden administration. That's why you're seeing the vitality, I think, in the market since the election.
Mick, what do you think this tells us just about how Trump policies are going to evolve? Are we going to see more of a follow-through this time around maybe than we did during the first administration?
Yeah, I think that's a good question, a fair question. I think the answer is yes. I think one of the biggest differences between Trump 2.0 and the original version of Trump is that they will hit the ground running now in January. In fact, they're already hitting the ground running. I think if we're candid with ourselves, back in 2016, not everybody expected Trump to win, and that included a lot of Trump team. So they hadn't done a lot of the work on the front end, getting ready to take over the executive branch of the government. They're not making the same mistake again. So you'll see a more expeditious sort of installation of the agenda, more effective sort of work coming out of the executive agencies. I'll give you a classic example. They were teaching themselves how to draw executive orders this time back in 2016. They've already written them and they're ready to go here in 2024. So what you liked about Trump 1.0, you're going to like even more in this new iteration. What you didn't like, you're going to dislike more, just because they're going to be better at doing what they want to do.
And Mick, we've continuously heard from investors and analysts on our program here that part of this post-election rally in the market is the idea that the market is going to be the third check on the Trump administration beyond the judicial and legislative branches. Do you buy that? Have you seen evidence of Trump utilizing the market as a feedback engine?
I've seen it generally in Washington. The answer is yes, but he's not the only one. I've seen it. We go back to the global financial crisis when the stock market dropped during a vote on the floor. They were using that as a feedback loop to try and get people to change their votes. So if the question is, does Washington look at the markets? Yeah, and they should to a certain extent. They can't let it dictate policy. But if you're wondering what the world and the markets think about your proposed policies, look at how the markets react when you push something out. I'll never forget, we used to have a running joke in the White House that every time Peter Navarro went on television back in 2018, the market dropped 200 or 300 points. So there's a great feedback loop as to what any administration, what any government is saying and how the markets receive that. And that's a valuable piece of information for lawmakers.
Mick, I'm curious to get your perspective on this. Who do you think is going to be most influential when it comes to shaping Trump's policies here over the next 4 years? Who is that key person that Wall Street, that investors need to be paying closest attention to?
Yeah, there's no one. That's not how Trump works. If you want to ask me who the most single important person is, it's Trump. So if the market wants to watch a single person, they should watch and listen to Trump. But if the question is who is going to be in the room and sort of formulating policy, there's not going to be sort of this one guru that Trump listens to. He listens to a lot of different people. He's going to be listening to Scotty Bessent over at Treasury. He's going to be listening to Peter Navarro and wherever Bob Lighthizer ends up. The new guy at Jameson, I think it's Greer at USTR. I don't know him as well as I know the other folks. Kevin Hassett is going to have a great deal of say in those meetings. There's a variety of opinions on different economic and trade policies within that group that I just identified. And Trump is going to be the one who sort of sits back, lets them fight amongst themselves, and sort of acts as the moderator, the mediator, the judge as he arrives at the final decisions on policies.
Mick, it was great to get some of your time. Thanks so much for joining us here this morning. Mick Mulvaney, Actum Strategic Advisors co-chair. Thanks so much.
Thanks to you. Happy Thanksgiving.
You too. Coming up, President-elect Trump's proposed 25% tariff on Mexico could be bad news for U.S. automakers. Find out which stocks are most exposed. That's coming up next on Catalysts.
President-elect Trump's proposed Mexico tariffs could deal a major blow to the U.S. auto industry. The big three automakers, Ford, Stellantis, and GM, all have plants in Mexico and could face higher production costs if Trump follows through on his threat to impose a 25% tariff on imports from the country. Here to discuss further, we got Tom Narayan, RBC Capital Markets Global Autos lead equity analyst. Tom, it's always great to speak with you. I was looking at some studies this morning indicating that the price increase for some of those companies I just mentioned would be about $3,000 in additional charges per vehicle. To what extent do you anticipate that getting passed down to consumers?
Yeah, I think what would happen if this actually happens is exactly that. It would be mostly passed through to consumers, which, by the way, is a reason why I think this won't happen. I don't think this tariff will actually happen because the administration ran on a campaign of curbing inflation, not causing it, right? A car purchase is one of the highest optical purchases you could possibly make, I think second to your house. If we see car pricing, which is already high, go up even further, I think that would be optically negative. We also remember what happened in the first go around with the Trump administration. Similar tariff threats on Mexico were made. They never actually happened.
Tom, let's go with the theory that maybe it is going to be implemented just for this. Who is then most at risk? When it comes to the big three automakers here in the U.S., who should investors be keeping the closest eye on?
Yeah, the one that's the most hit would be General Motors, GM. They have the most production capacity in Mexico. If you did the math on a 25% increase on tariffs there, also they're just the most U.S. exposed. It would theoretically result in a down 8% on estimates. Now, the stock was down 9% yesterday, so the market is clearly pricing that in. Again, we don't think it happens. And today, the stock is up like 1%. So it would imply that the market is digesting an overreaction yesterday. But of those Detroit three, it would be GM.
So when is it real, Tom? When does that policy position become a real material impact that investors should be positioning around?
Yeah, unfortunately, it's when you're dealing with threats, as we saw that happened in the first go around, it's just an overhang that's just always there. So it's going to continue to pressure these names. We would advise folks to look past it because we don't think will actually happen. But unfortunately, it will just pressure stocks until we get some clarity. If there's an official statement that, these are the exemptions that will be allowed. And then we know there's certain names that it doesn't apply for, which we think will be pretty much the entire auto ecosystem. So until we get clarity on exemptions or the kind of devil in the details, like what happened in the first go around, unfortunately, these shares could be a little bit range bound because of this overhang.
Tom, real quick, we only have about a minute here, but what does all this mean for Tesla? Is Tesla the winner here in this scenario if we were to see tariffs imposed?
I don't know. I mean, I've heard this argument. Again, I mean, if tariffs are imposed, then it would hurt ICEs. We think that Tesla's main competitor is other ICEs, not other EV makers. But then again, taking the IRA credit isn't really great either for Tesla. I think they benefit from that. So yeah, maybe at the margin. But again, we don't think these tariffs will actually ever happen. But yeah, if it does, maybe it benefits them.
Tom, we always appreciate the honesty. Tom Narayan, thanks so much for taking the time to join us. RBC Capital Markets Global Autos lead equity analyst. Have a very happy Thanksgiving.
You too.
Coming up next is Wealth. It's dedicated to all of your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're talking about the stocks that we are thankful for ahead of Turkey Day. We'll also zero in on retail stocks post-earnings. One analyst gives us his take on the best positioned retailers. Looking forward to that conversation. Plus, we'll do a check of gas prices ahead of the long holiday weekend. We'll bring on an expert to give you some tips to save cash at the pump. Plus, younger workers are taking micro retirements. You heard that right. We're going to define the trend, explain how it works, and bring on a financial planner to let you know how you can potentially incorporate it into your life. All that and much more coming up on today's show. But first, let's take a look at some of the market action as we are 90 minutes into the start of today's trading activity. We're mixed right now across the major averages, at least, with the Dow right now higher by about 0.04%. The S&P 500, though, and the Nasdaq, they are down. A fresh read we got today on the inflation front. The Fed's preferred inflation gauge coming in line with expectations. Joining me now for much more, we've got Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. So let's get a sense of the economic data that we're receiving over the course of this abbreviated trading week and ultimately how that flows through to people's portfolios too.
Thanks, Brad, and happy Thanksgiving from all of us here at Zacks to you guys as well. And what we're really seeing is kind of just some stable data that doesn't necessarily reflect anything super bad, but nothing super good either. And so what it relates to is the S&P trading right around 6,000 as we speak today. You're at a valuation of around 23 times next year's earnings. How is that going to continue to be supported? Looking at GDP, no revision on the first read, which is good. 2.8 is okay, but it's not great when you consider the fact that there's really no energy in the labor market in terms of job gains. We're actually holding steady at job losses as well. Wages are relatively flat. So everything seems to be kind of idling right now. What you would be worried about is a significant change in either direction. Do we see significant job losses increasing, and that might make the unemployment rate go up? Or do we start to see wage gains go up, and that might make prices go up as well? So we're finding that there's a lot of energy in the positive in terms of a pro-growth type of a trade that you guys have been talking about all morning. We certainly understand that, but we start to get concerned about, does this level of valuation continue to be supported when that growth in terms of real earnings and real revenues is being supported by so few companies? Really only about 25 to 30 names in the S&P 500 account for all of next year's earnings growth in terms of around 8 to 10% of what we expect at this point in time. So simply what we're saying is we're at a moment of inflection as we change administrations and different policies start to come into play. You're really going to want to know what you own and know why you own it. And so we're looking for a couple of names that have real durable earnings structures in a couple of sectors that have done very well. Financials up 36% year to date as of last night. Utilities up around 30%. That's both better than the S&P 500 up around 24%. So those are places where you can reach into and actually find better growth structures that have more durability to them than the broader market itself. So in particular, looking at financials, JP Morgan is a name that we like very much. They are one of the largest banks in the world. They have a very robust pipeline of investment banking opportunities, as well as hopefully with deregulation and lower interest rates over the next year or so, we see a more robust M&A type of market activity and maybe even hopefully some more IPOs. Really, since 2022, we have had very low activity across the board from that investment banking perspective. So there's an opportunity there. A company that trades at a PE of roughly 15. Right. It's only up around 20% year to date compared to the financials at 36%. So on a relative valuation basis, there's a very strong growth name that hasn't run as hot as everything else in the marketplace, but it also has very good downside protection at this point in time. And beyond that,
yeah, I was just going to say, and it sounds like, a lot of that thesis kind of baked in, certainly surrounding the underwriting part of their business for what you were laying out there a moment ago. As you think about JP Morgan, juxtaposed perhaps against some of the other areas of the market that have been the sexiest trades to this point, which has been everybody discussing AI, which I imagine AI is going to come up at people's Thanksgiving tables this year. How would you be telling anyone to navigate that investment conversation as they're just passing the stuffing, especially considering how far it's run so far?
Yeah, absolutely. I mean, the way that we view AI is we want one answer to one question. That is, how are you monetizing it? A lot of money, CapEx being spent investing in this technology in a lot of different ways, but who's actually closing the loop and selling a product using AI? And that's where you start to whittle down the amount of names that come up in this bucket, and you start to look at fewer and fewer actual businesses that are monetizing AI. And that's, one of the things that we are cognizant of over time is the largest internet company in the world 20 years ago was AOL. And they're not here anymore. They didn't manage their balance sheet properly. They weren't profitable. And those are one of the areas that you really want to be careful of is unprofitable stock price appreciation, right? If it's just all momentum and happy vibes, there's a lot of stuff that can happen around that. But you want to back it up with real earnings and real revenue. And that's where we're looking at things, I think, a little bit more conservatively, just because the amount of money that has been spent over this period of time has been so much. Now you're carrying a lot of burden on some of these balance sheets that has to get paid back somehow. And really the only way that's being closed at this moment in time is through subscription models.
Right.
It's been great for companies like Netflix and things of that nature, but the only AI businesses out there that you can point to that have a road to profitability are just simply selling subscriptions to interact with chatbots. And that's it. The rest of it, self-driving cars, all of that other stuff, lots and lots of capital being invested researching that technology, but it's not available to be purchased yet, which means there's not really a road to profitability.
Brian, we only got about 30 seconds left here, but as we're having these conversations about stocks that we're kind of looking out into the future, opining on, trying to provide some deep analysis for our viewers, let's just take a look back at this year. What stocks are you most thankful for this year?
Really, the utilities trade is one that was unexpected, and it's AI adjacent, where you really find a lot of stock price appreciation because the revenue growth is really there. The amount of power demand that will be needed to fuel AI and data centers is real, and that translates to real earnings growth. And so a stock like AEP for us has the country's largest transmission grid, over 225,000 miles of transmission, meaning all that electricity is going to have to pass through a fair portion of their network that they can collect revenue on. That's what we like and we're thankful for, are real earnings and real revenue growth, and that's what we want to try and own for a long period of time.
Brian Mulberry, who is the Zacks Investment Management Client Portfolio Manager. A happy Thanksgiving to you and the team. Thanks so much for joining us. Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, robotics company Symbotic plunging after filing to delay its 10K annual report. Now, the company says that it needs to assess the financial impacts of an error related to how they recognize revenue. The impact of correcting these errors will mean lower profits for 2024. Symbotic also lowering its Q1 revenue outlook. And we're also tracking here today cloud computing firm Nutanix, reporting first quarter results, beating on the top and bottom line, second quarter revenue guidance surpassing analyst expectations. Nutanix did reaffirm its full year forecast and says it's taking a bit longer, though, to close some deals in the current macroeconomic conditions here. Elongated deal cycles, what they're talking about. Investors trying to price that in today. Also, finally, the top trending ticker on Yahoo Finance right now, Dell, falling after reporting revenue that fell short of expectations. The computer maker also issuing a weak outlook. Dell is citing robust opportunity in the AI landscape, but says that the business will not be linear. Switching gears here, let's talk a little retail. Retail earnings wrapping up for the third quarter with just a few outliers on the docket in the coming weeks. We want to hand out end of the year, well, end of the quarter superlatives. It feels like end of the year for retail, especially as we enter into the holiday shopping season. But all that considered, we've got some end of the quarter superlatives to give the companies that have reported. Here to help me do so, we've got Simeon Siegel. He's the managing director at BMO Capital Markets. Great to see you. Great to have you here with us. So as we get some of these superlatives, of course, this is kind of encapsulating what's taken place to this point in the year. But of course, the big part of their year where they try to get back into the black for many of these retailers, it starts right now. It starts this week. So as we get to these superlatives, let's start with the retailer that's most reliable. And you're saying TJ Maxx on this one. Why?
By the way, this is not the end of this is the beginning of the year for this world.
Yeah.
Everyone's ready. All the operators now are thinking like, okay, we got like one more day until it's game on. So I like that. Listen, I think that right now, and listening to the last segment, wanting to be conservative, I think is really interesting because in this market where all these multiples are going through the roof, being conservative feels difficult. And so the way I'm trying to think about it, the way I'm speaking about it with my investor clients is you have to decide, do you want to take a risk on the valuation or do you want to take a risk on the business performance? And so spreading out that, making that dichotomy, I think is important. With TJX, I do not feel like I'm making a bet or there's any risk on the numbers, on the business. The question is the multiple. And so recognizing the market multiple, that's going to be your question. And so with this specific one, this is called the safer bet, because here's a business that's going to compound. Here's a business that's going to have long lines in person, not online, because they don't have it. So here's a business that people get to go. It's value to the consumer. And as you and I have always talked over the last many years, it's increasingly a quiet value to the brands. And so a brand having an invisible place to sell a lot of goods is very important as they just want to move a lot of units.
Certainly. All right, so TJX wins the most reliable superlative. What about most likely to improve? Who do you see taking the cake on this one?
Okay, so other side of the spectrum. So now less risk on the multiple, more risk on the numbers. So that would be a turnaround. Under Armour, which you and I have talked about in the context of both donating share to all the other players, but also as this business turn, I think doesn't get enough credit. I think we hear Under Armour, and I'm sure a lot of people just heard me say Under Armour and said that's a dead brand. The reality is it can't be a dead brand. How do I know? Because it's got $5 to $6 billion of revenue, arguing otherwise. Now, it doesn't make a lot of money. And so it seems a lot like a tech business with a lot of revenues and no profits, but here it's selling shirts and shoes. That means it's under earning specifically because it's overselling. And so now the company is affecting a turn. Now the company is actually trying, in their words, to achieve more by doing less. That can be very powerful in retail. And I think we're in the middle of seeing that. And so we've watched the stock act really well. My team did thanks to them, they did a really nice deep dive, really dissecting the opportunity there. And I think we're seeing it being put into place. And I think we're in the middle of what I think will be a nice turnaround for this business that has effectively been left for dead.
Yeah, it's hard to imagine any brand that has Steph Curry on their roster as being a dead brand, but that has certainly made it into the conversations for sure. Let's also hit one more here. The biggest underdog, and you say that this one is Bath & Body Works, a company who we just heard from in their own earnings report, and you say it's under earning but undervalued. Tell us why.
Yeah, so that was I split the two for the others. So with Bath & Body Works, straight down the middle, a little bit simpler. If they get revenues, the stock explodes. If they don't, people freak out. I think there's more to a business than that. I think that we're watching volatility of the stock tell us what people feel about this business. But here, what they very consistently and very replenishmently, not an adjective, but we'll just throw it out as another one of your superlatives. They are a business that get people to buy with an emotional attachment tied to seasons, a product that burns and therefore you have to buy it again. And so they have a nice blend of a staple, of a need-based purchase, as well as a want-based purchase. And so what we need to do, we're still, as wild as it sounds, we're still working our way through some people's supply post-COVID. People overbought candles at home because they stayed home every day. And so as wild as that sounds, that is still a thing that we're working through, but they just signaled they feel like that's not going to be a problem anymore going forward, or it's going to be a minimal. So we have worked through that. And so here's a business that has a very nice margin. Think about what product you're buying that has a very nice margin. It has a replenishment nature built in. And right now the stock is sitting not on its lows because we just had a nice report last week, but close to them. And so it's improved its balance sheet. It's moving increasingly off mall, and it's got that replenishment nature into holiday for a business that I think is still viewed with a lot of fear.
They have a subscription service that I didn't even know about. I mean, I just looked it up and found out about that. Do you think that the model needs to change more towards really tapping into the people who are Self-Care Saturday aficionados and people who are scent aficionados who really want to make sure that they're taking that time of their own and making it feel like a bathhouse in Williamsburg, even if they're not being able to get to a Bitcoin mining type of oasis, if you will?
Brad, I know you've got a shelf full of 'tis the season and sweater weather scented candles.
Live, laugh, love, Simeon. Live, laugh, love.
So I think that what we have here, I think there's an interesting dynamic where if Starbucks only sold pumpkin spice lattes, they would be a one-season place. And I think Bath & Body Works for a while was perceived as a one-season place. I think there were certain people that would go in the holiday, and there were certain people that would go for when the fall hit, and it was a very seasonal catalyst-driven purchase. And by the way, out of all my whole coverage, Bath & Body Works has the greatest Q4 exposure. So we talk about the beginning of the year. This has been all that has mattered. This quarter is all that has mattered for them because people flock to it, both on its discount, but also because this is the season to light candles. What I think they did that's actually interesting, and we'll see how large this becomes, how important it becomes. But one, they've introduced adjacencies, so they now have men's deodorant. They now have detergent. Like they're jumping on their control and their dominance of the scent market, of things that smell.
Yeah.
And so they're moving past what is normally seasonality, which is really good. On top of that, they're doing collaborations. So they had a collab for Stranger Things that works its way into holiday. That makes a lot of sense. Okay. With Bridgerton. I think this idea of smoothing out the business, of not being tied directly to specific holiday catalysts, allows them, one, it's easier to forecast your business if you know you're doing something other than the last quarter of the year. But two, it brings people in a different way.
Yeah. Simeon, we got to leave the conversation there. I could talk scents, fragrances, and deodorants with you all day long. I hope you have a great Thanksgiving as well. Simeon Siegel, Managing Director at BMO Capital Markets. Appreciate it.
Happy Thanksgiving.
Guys, coming up, investing through ETFs. We'll talk about the Trump trade in your portfolio. And President-elect Trump plans to impose tariffs on a number of countries. We'll talk about that effect and how it'll affect small businesses specifically versus corporations on the other side of the break. There's still 54 days before the inauguration of President-elect Donald Trump, but that is not stopping the so-called Trump trade from fueling some rallies across industries. The president's policies are expected to boost. I want to bring in Aniket Ulal to discuss how investors can use ETFs to play the Trump trade as part of this week's ETF report, brought to you by Invesco. Good to have you here with us. So help us break this down first. What ETFs, as of this juncture, and what industry or sector exposures have you seen the most flows as it relates to the so-called Trump trade?
Well, there's a difference between performance and flows. As you know, sometimes flows tend to follow performance. Maybe we can talk about performance first. In terms of performance, we've seen financials react very positively after the election of President-elect Trump. In particular, we've seen regional banks do very well. If you look at tickers like KRE, which holds a bunch of regional banks, those have actually reacted very positively to the election. That's partly driven by expectations of looser regulation, expectations of the new administration being less hawkish on antitrust. So in other words, expectation of more M&A activity. That's also driven ETFs that are focused on exchanges, more capital markets related. One ticker is IAI, as you just showed on your screen. So IAI, KB, WB, KRE, these are all tickers within the financials sector that have actually benefited as part of the Trump trade.
And you mentioned there's kind of two ways to think about or talk about flows, performance, and then what is the other? Because to my understanding, the flows that we're seeing, the inflows into ETFs over the course of this year are expected to hit a record or perhaps cross $1 trillion. Correct me if I'm wrong or not on the record.
You're absolutely right. This year, for the first time, we may expect in a calendar year to see flows into ETFs in the US exceed $1 trillion. We'd already passed the record, actually. The record was actually in 2021, where we had about $911 billion flow into ETFs in the US. We're already at 950, so we're already past the record. We now could pass $1 trillion. Historically, if you look at flows on a seasonality basis, the second half of December tends to be the strongest in terms of money coming into ETFs, particularly to big, broad ETFs like SPY, IBV that track the S&P 500. This is for a variety of reasons, investors rebalancing their portfolios at the end of the year, hedge funds equitizing cash, and so on. So we think we're on track to exceed $1 trillion, which is both a testament to the ETF product structure, as well as, of course, we've had a very strong year in equity markets. So like you said, both in terms of performance and flows, it's been a very good year for ETF investors this year. So we're kind of, now that we've finished a 2-year bull market, I think ETF investors are looking at what's going to happen with the new administration and what's going to happen in the new year.
So with that in mind as well, the incoming administration and President-elect Trump have been posting on social media about what potential tariffs may look like in the countries that they would be targeted at, the industries that they might impact, as well as has really been rattling throughout the markets over these past few days and trading sessions. All that considered, where do you anticipate that we might see some fluctuations in ETF activity as a result of tariffs?
There's really two elements to this. I mean, President-elect Trump has been talking about China for a long time, but he talked about even 50-60% tariffs on Chinese imports. And some of that might be rhetoric to negotiate with China. So we'll have to see what actually happens in practice. That's actually had a big impact on how ETFs have reacted. We've actually seen in the last year a lot of inflows into emerging markets, ex-China ETFs. Historically, China used to make up about 25-30% of emerging markets exposure. And so investors are trying to diversify away and look at ETFs that hold emerging markets like India, Taiwan, and so on, Vietnam, that could benefit from some move away from China. So that's one effect that we've seen, which is the China effect and some demand for emerging markets, ex-China ETFs. More recently, President Trump has talked about Mexico and Canada. That's, as you mentioned, he posted that on social media.
Yeah.
We've actually not seen as strong a reaction on Mexico. The Mexico ETF is only down about 5% since November 5th, since election day.
Right.
So the part of that is also driven by the fact that some of that exposure is very domestic, right? The biggest sectors in that ETF is staples. You've got companies like Walmart, Mexico, big banks that are more domestically focused. So the ETFs haven't reacted as much yet. But of course, this is all fairly new, and we have to see how things play out.
Aniket Ulal, who is the head of ETF data and analytics at CFRA Research. Thanks so much for taking the time here with us today.
Thank you very much.
Certainly. President-elect Trump has proposed 25% import tariffs on America's biggest trading partners, Canada and Mexico, as well as a 10% tax on imports from China. Although tariffs are targeted towards other countries, Americans and businesses, they certainly do pay the price. And history has the results there, but here with how tariffs could affect small businesses. I'm joined by Elizabeth Gore, who is the co-founder and president of Hello Alice, a free online platform helping businesses launch and grow. Liz, great to have you back on the program with us. Let's just first talk about the short-term and long-term impacts of tariffs on small businesses.
Howdy. Thanks for having me on. Happy Thanksgiving. You know, it's really important for us to delineate what the corporate impact is versus Main Street. So where I get concerned in the short term is if you think about the increase in costs of the unit economics for small businesses, foodstuffs, textiles, electronics, that is really going to increase the cost to these small business owners. And they're either going to have to absorb that or they're going to have to pass it on to your local Main Street customer. And that's a tough thing.
And so how do you foresee this small business environment navigating through some of the most large events like a Small Business Saturday that's coming up, and then going out into next year? How critical is this Small Business Saturday for the companies that are trying to make sure that they can set themselves up well to begin 2025?
Well, first of all, I want to encourage all Americans to go out and shop small. At Hello Alice, we have 1.5 million small businesses that are hoping that you're going to walk into their store or go online and buy those gifts. This is an important time for receipts. But our small business owners are resilient, particularly coming out of COVID and reopening their doors. I think they're being smarter about their cash flow. And what concerns me on the tariffs is if these prices suddenly jump up, they're just not prepared for this. Now, there is a long-term opportunity with tariffs, and that is actually bringing jobs inshore, supply chain inshore. So I would love to see that an end result of this be that small businesses are getting contracts, they are becoming suppliers for federal government agencies and for our corporations here. That would be a positive long-term benefit.
Elizabeth Gore, who's the co-founder and president of Hello Alice. Elizabeth, we got to leave things there today. Appreciate it so much. Thanks for joining.
Happy Thanksgiving.
Happy Thanksgiving. Coming up, everyone, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories you don't want to miss. Stay tuned.
We are 2 hours into the trading day and it's time for Yahoo Finance's market update. Stocks are down with the Dow just flatlining at the moment, and here are 3 trending stories to watch. Long-term Bitcoin holders set record high daily realized profits of $2.02 billion according to Glassnode. Recent selling action is mostly from investors holding coins for less than a year. And Baird initiates coverage of Expedia Group with an outperform rating and a price target of $225, noting a transformation in the business model and an ongoing turnaround. And markets are closed Thursday, but the shortened Thanksgiving trading weeks are typically bullish for the S&P 500, closing high at 77% of the time on Wednesdays and 69% on Black Fridays. And that's your Yahoo Finance Market Update. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending ticker page. More wealth when we return.
AAA is expecting record-setting travel for this year's Thanksgiving holiday. According to their estimates, nearly 80 million Americans will travel 50 miles or further, and almost 90% of those travelers will be driving. Joining us now to discuss all things holiday travel, we've got Alec Slacky, who is the AAA Managing Director of Public and Government Affairs. Great to have you here in studio with us. I mean, this is you guys' Super Bowl, as you were telling me during the break. So just what are some of the anticipations as we are squaring up this holiday season?
I mean, we're expecting record numbers of people driving, flying, traveling overall. And I mean, from the last couple of days so far, it seems to be panning out. And it's really just been a strong couple of years for travel. That kind of revenge travel couple of years is kind of slowing down as of a few months ago. But Thanksgiving is one of those holidays that it doesn't really matter what the overall travel trends are. People want to see family and friends.
What is the medium that people are using to transport themselves to family and friends? And is there kind of any major delta in the number of ways that they're trying to get there this year versus last year?
Honestly, it's still road trips. Road trips still number one by a huge margin. Nearly 72 million Americans were expecting to drive to their destinations. Of course, you know, when you have almost 6 million people in the airports over the holiday period, you know, that it seems really busy as well, and it is. And trains, cruises, other modes of transportation, we're seeing those go up. So pretty much across the board, big year for all modes.
What is the reason that gas is cheaper this year compared to last year? I mean, is there a driving force behind that we're seeing?
Yeah, I mean, I think there are a few things. I think the oil market, there's a good amount of supply, and that's why we're seeing OPEC plus meeting in a couple of days. They're expected to probably extend production cuts because there's a good amount of supply, and that has helped push crude prices down. Obviously, we're in a little bit of a lull for demand as we get towards the end of the year. That seasonal trend shows lower demand. So those are a couple of the reasons.
What are some ways that people who are driving and taking to the road can save money at the pump?
You know, there's always people that want to shop around for the cheapest gas, whether it's by a penny or two, and that's certainly worth doing, but we don't want you traveling a couple miles out of your way to then find the cheapest gas, because then you probably already spent more money getting there. So if you can keep your tire pressure in the right place, because that's going to help keep you safe. It's also going to help your fuel efficiency. Take things out of the car. Certainly combine trips if you can. Don't use premium gas unless the car says you need to use premium gas. You can find a credit card that has gas specific rewards. So there's a lot of different ways. And you know, go the speed limit. Go safely. Drive safely. Don't brake hard. Don't accelerate quickly. You know, that's good for safety, and it's good for fuel efficiency as well.
You know, we were speaking with a guest earlier in the day, and we were talking about airfare costs and them actually moderating just a little bit lower here. If that continues, do you think that impacts some of the road trip planning that's already taking place for next year? I already have a family member who told me about a road trip that they are planning for 2025.
I mean, I think it's possible. I think road trips still are going to be, you know, by far the most common way to get around for holiday vacations or for any other sort of vacation. But I think as we're seeing that growth in air travel start to subside a little bit, you know, maybe the prices moderating will help pick it up again next year. We'll see.
Alex Latke, who is AAA Managing Director of Government and Public Affairs. Thanks so much for taking the time here.
Thanks.
Absolutely. Well, Black Friday just days away here, and while it may have been years since you lined up for those in-store sales, breaking down doors, we've got some new data from Placer AI, and it's really suggesting that the doorbuster deal is seeing something of a comeback here. Joining us now for a look at the Black Friday retail forecast, we've got RJ Atovi, who is the head of analytical research over at Placer.ai. Great to have you here with us, RJ. So first, as you think about some of the trends that you're seeing right now that are playing into the Black Friday deals, what are your anticipations and what's the research telling you at Placer?
Yeah, thanks for having me, Brad. Our data suggests that it's going to be a fairly strong Black Friday holiday. What we're seeing is that it's still a very deal-driven, a very value-conscious consumer, one that has really been waiting for those doorbusters, those big promotions. They took a pause. Most of the consumers took a pause in the early part of November, but as those Black Friday promotions started kicking in the last week and then into this week, we started to see a rebound in visitation trends across a lot of retailers. So giving us some optimism for the Black Friday holiday. You know, again, very much focused on values and deals right now, but as you pointed out, we're starting to see a bit of a comeback of those doorbusters that we saw once upon a time, and really consumers focused in on that.
What are the deals that are leading consumers to say, you know what, I'll go stand in line, I'll be part of that doorbuster number?
It's a little bit of everything. I think it's some of the traditional categories that you've come to expect, some of the more apparel, some of the more consumer electronics, sporting goods. We've seen some deals on that front. Some of those things are really driving, but some of the classic brands too. We're starting to see things, maybe not doorbuster, but nice promotions from like a Levi's or kind of the classic American brands that are out there as well. So I think we've kind of seen a resurgence on that front, but it's a little bit of everything. We really did see consumers take a pause on a lot of discretionary categories. Essentials, obviously, we're still very much solid visitation trends for those through the month of November. But really, we start to see more of the discretionary categories start to make a comeback. Luxury, apparel, sporting goods were the ones where we started to see a lot of traffic the last week or so.
What is if there is a minimum percentage discount and promotion threshold that you're seeing consumers flock to?
There's not a hard and fast number on that, but I do think something about 30-40% discount seems to be kind of the trigger point that gets a lot of consumers into the store right now. Again, it can be different for different product categories, but it really does have to be something where consumers feel like they're getting their worth of while, getting something, maximizing the value for that trip out to the store. And so I think it's got to be something where it's not just your run-of-the-mill discount that you're going to see kind of during normal sale periods. It's got to be something a little bit more than that to drive people to the stores right now.
And so how are we anticipating this holiday shopping season to pair up against previous ones? We've got more digitization. You have more competition on the brick and mortar side versus the digital landscape. And then, of course, you have a consumer that's trying to make sure that they're smart spending over the course of this holiday season.
You're absolutely right. They are smart spending this holiday season. But what I think is going to end up happening, one of the things we've seen the last 2 years is really that consumers are willing to spend for events and holidays. That has really been kind of one of the big catalysts for them to come out to the stores as well as buy online. I think both the physical stores and online will both have very successful holiday seasons. And a lot of it comes down to this idea that people still want to celebrate events and holidays. It's been a big thing we've seen across much of this year. We saw for Valentine's Day, Mother's Day, Father's Day. And so this idea that people still come together and spend and make visits to stores during holiday periods, I think continues. Obviously, that's something that happens every year, but it seems more pronounced post-pandemic. And it's really those shoulder periods in between. That's where consumers are more cautious. So given that, there's been a lot of pent-up demand for these year-end holidays, I think we are going to end up having a nice holiday season, both physical stores and online.
What does it take for doorbusters to really beat digital? I mean, I often see some of these digital offerings, and it seems like they're able to offer more percentage discount because maybe they don't have the same type of overhead that they have to account for within those promotions that the same brick and mortar stores are trying to make sure that they don't cut too deep into their potential profits.
One of the things that we've seen is it really comes down to product exclusivity. Is there's something unique about that certain product at a doorbuster? Maybe it's not just your run-of-the-mill everyday product, something unique that you're only going to be able to get through that doorbuster event. That is something that we've seen be a major motivation for a lot of consumers in the past. We started to see some retailers start to toe the water on that, but it feels like we're seeing more exclusivity, limited edition products, collaboration products, things like that are going to be driving. Even we're starting to see a little bit of on the AI front too, in terms of product and flash sales and things like that to really drive people in the store. This can be both physical store and online, and you're right, inventory risk may not be as much for some of the online retailers out there, but at the same time, it is a risk for them. And so there is this need to clear product, clear assortment, clear inventory ahead of the holiday season and get ready for the next season. So I think it's important for both channels here, but at the end of the day, it really comes down to the discount level, the product itself, and the exclusivity of that product. That kind of really, I think, the three factors that we'd look at in terms of driving people to stores.
RJ, just lastly while we have you, we spoke to the CEO of JCPenney earlier, and this is a brand that is and a retailer that's in the midst of its own larger turnaround strategy as well. As you think about the mall and how critical that's been to inspiration and finding that inspiration where you're going into a physical place to then try and make a purchase in a marketplace there, what is the pathway back to being in good graces with the consumers on such a massive scale with the malls look like, and for some of the kind of tentpole stores like a JCPenney?
It's a great question. It's one that we spent a lot of time looking at too, because I think the way you and I interact with the mall right now is very different than it was pre-pandemic. And what we've seen is that those mall operators that have adopted a mixed-use strategy, and by that I mean that have adopted more co-working, more office, more residential to make it kind of more of a community center, are the ones that are seeing higher visitation trends. And in a lot of cases, they're seeing higher visitation trends than they were post-pandemic or pre-pandemic. And what you're starting to see is people are coming in from a further distance. A lot of times they're visiting more frequently. And more importantly, the tenants at that mall are oftentimes seeing a lot higher visitation trends than their same branded stores in the neighboring areas. So I think that that's kind of the advice as we're kind of looking at, JCPenney and some of these former anchor tenants. Maybe you still want to be part of this, this new mall as they continue to evolve. Maybe that requires a smaller format. We have started to see a lot of the department stores shrink the size of their box. We've seen it with Bloomingdale's, we've seen it with Macy's. And what they're doing is better targeting specific consumers within that mall, that trade area. I think that may be a strategy for them to look at, is maybe a smaller trade area or smaller box, but then better focus on your kind of core customer with that too, under the context of kind of this mixed use, new evolved mall that we're seeing out there.
Yeah, mixed use indeed. I mean, my goodness, we've got skiing and snowboarding happening at malls now. You've got bungee jumping. I mean, what is there not at a mall these days? And so hopefully,
but it does drive traffic. It does drive traffic, so that's key. So
and it keeps you there longer too. RJ Hadavi, who is the head of analytical research over at Placer.ai. RJ, great to see you. Happy Thanksgiving to you and yours.
You too. Thanks.
Thanks. It's time for Tech Support, our weekly segment all about technology. And today we're keeping the Black Friday theme going with the best deals that you'll see over the weekend. Yahoo Finance's own Dan Howley has all the details that you need to know. Dan, let's start with something that's near and dear to your heart, which is gaming.
Yeah, Brad, there's a number of big game deals going on this Black Friday, from Nintendo's Switch to Microsoft's Xbox Series X to PlayStation 5. All are going to be on sale for Black Friday. Look for bundles in particular. That's where you get a game, the controller, and the console itself for a discounted price. Speaking of controllers, those are also going to be on sale. And since they're pretty pricey now, some of them go for $80 a pop, getting a few dollars off is a big deal. So PlayStation 5 controllers are going to be $20 off. That's a big sell there. And then subscription gaming services. We're talking about PlayStation Plus, Microsoft's Game Pass. Then you have deals for things like Valve's Steam, which is a gaming storefront, as well as Roblox. They're all going to be selling some kind of cards at a discount that you can give to people for the holidays, or just, scoop up for yourself.
And so, all right, that's the games, but what about the TVs that you need in order to play some of those games?
Yeah, so when it comes to TVs, there's two things you want to keep in mind: the type of TVs and the price you're going to buy them at. So there's LED TVs, which are your standard TVs. There's QLED TVs, which are a step up, provide better color, better darks. And then there's OLED, which have the best picture you can get as far as color quality goes. And so if you're looking for that, go with an OLED panel. You can get them from Samsung or LG. LG's offering them on sale right now for Black Friday. The QLED panels at Samsung are also going to be on sale as well. And then you'll see different kind of doorbuster sales. Now let's talk about the price. If you see something that's really low in price, $300, $400, it's probably not going to have the best image quality. Don't get me wrong, there's going to be some that are going to be good, but I think a good rule of thumb is to keep in mind that you're getting what you pay for the most part. So if you get a $300, $400 TV, don't expect it to have the image quality of something like an OLED or a QLED, unless, they happen to be selling an OLED or QLED for really cheap. It's probably not going to happen, but just something to keep in mind.
Dan, you and I have taken a look at some laptops here on set before. Are there any good laptop deals out there that caught your attention?
Yeah, there's actually a number of good laptop deals. And this is another thing where it's, you're going to get what you pay for. So there's going to be some MacBooks on sale. I actually just found an M2 powered MacBook. That's the M2 chip that's on sale. You can get gaming rigs from the likes of Asus or Asus, depending on how you pronounce it. And then Microsoft's new Surface, that is the Copilot PC, uses Qualcomm's chip. Those are also on sale for Black Friday. And you'll see a slew of deals at Amazon, Walmart, Best Buy. I think, again, if you're going to find a laptop that's like $300, $400, it's probably not going to last you that long. There's a reason why it's that cheap, and that's why they're selling it, just trying to get it out the door. If you are looking for a long-term laptop that you're going to hold on to for a while, you're going to want to spend a little more money, but they'll still be on sale.
Finally here, just quickly, headphones, from the buds to the over-the-ear, what's hot this year?
Yeah, so Apple's AirPods are going to be on sale, not the newest version. It's going to be the prior generation versions of the AirPods Pro and the standard AirPods. You can try to see if you can find some of those AirPods Max, those big over-the-ear ones. But I would say when you're shopping, you want to make sure that you're looking for either in-ear, those are the buds, or over-the-ear. So there are a lot of over-the-ear companies are selling them pretty inexpensive. There's a Bose Quiet Comfort that's very, very good, active noise canceling, and on sale.
Dan Howley, thanks so much. Appreciate it. Guys, retirement in your 20s. Guess what? We're going to break down the micro-retirement trend and how it could benefit younger workers. That's next on Wealth. Welcome back. A quick programming note. On this week's episode of Living Not So Fabulously, NBC News and MSNBC correspondent Stephen Romo talks about unlearning bad money habits from childhood.
Trying to unlearn so much of what I learned about money from growing up, it's been the work of a lifetime. My parents they didn't talk to each other about money. They fought about money. They did not hide their money problems from my siblings and me. That we had 2 homes foreclosed on. We got kicked out of rental homes. And we were always very aware of what was happening. Like we couldn't afford this. We couldn't pay for this. So that's one of the reasons why it's been hard for me to engage with money and learning about money, because once I started making enough money where I wasn't having to worry about paying bills and paying student loan payments, then I sort of stopped making myself think about money. That was what I thought my reward was. I don't need to think about this.
And you can catch more of Living Not So Fabulously every Wednesday at 12 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. Workplace burnout is affecting 3 in 5 American workers, according to a recent AFLAC report. 66% of millennials ages 28 to 43 are facing moderate to high burnout, compared to 55% of Gen X and 39% of baby boomers. One solution could be something called micro-retirement. And here to explain, we've got Kate Gazel, who is the certified financial planner at Schwab Intelligent Portfolios Premium. Kate, great to see you. Thanks so much for taking the time here with us. First, what is a micro-retirement, and who is it most popular with right now?
Yeah, Brad, thank you so much for having me. Yeah, micro-retirement, it's not something they teach in school. This is a trend we're seeing more and more of here at Schwab. And it's becoming popular as people reject the traditional 9 to 5 until 65 lifestyle. And it's based on a really simple idea that rather than wait until retirement to take a break, choose to take 6 months off, maybe 1 year, maybe even up to 2 years off, and then return to work afterwards.
So
and this is coming up. Oh, sorry, go ahead.
No, please continue.
Well, I was just going to say this is coming up more often with probably our 20 to 30-year-old clients, right? They're more interested in having a more traditional, they reject the traditional working norms. They expect to find better work-life balance, but it's certainly not limited to our younger clients. Certainly mid-career professionals have also been interested in bringing up the topic lately as well.
So what are the benefits of a micro-retirement?
Yeah, I mean, there's a bunch. It's a biggie. Many report, the break enables them to find self-actualization, finding different work when they return. Maybe, they have a clear mind, a renewed sense of direction. In fact, we had a client here who was in his mid-30s, wanted to crew a sailboat for a year, and approached us about 2 years before he wanted to do it. And while he was crewing this sailboat, he actually found a business partner that was crewing the sailboat with him, pitched an idea to him, and they took off. When he returned to work, he returned to work with that business partner he was crewing with. And so you can really find really good opportunities when you're taking this break. But from a planning perspective, also, there's some opportunities you can really harness when you don't have income, such as considering Roth conversions, right? That's a really good time to take that opportunity when you have low income.
So what are the drawbacks, I guess, on the other side? Because you just mentioned you don't have an income, so you're drawing down on what you've saved up. So what are some of the drawbacks or risks, we should say, of a micro-retirement?
Yeah, absolutely. Us financial planners, we're a cautious bunch, right? So we're always thinking of impacts and what can go wrong. And certainly there are many potential impacts to your future when you do this. So the biggest one would be the impact to the retirement nest egg, not contributing to it, right? That will slow you down. If you take withdrawals from your retirement account, that will also be a problem. You're interrupting the benefits of long-term compounding interest. You also, if you're not working, you're foregoing any company bonuses, company stock, and that could also really interrupt the savings that you get to accrue while you're working. Yeah, and Also, the other major impact is salary growth, right? I mean, if you stop working, you're not getting the raise, you're not getting some of the promotions you might get while you're at work.
Kate, only got 15 seconds here, but what are the pillars of planning for a micro retirement?
Well, the pillars of planning would be just planning, right? Saving, save, plan. Get in touch with someone early, get in touch with a certified financial planner who can help you think through the ways to model this and prepare.
Kate Gazel, who is the certified financial planner at Schwab Intelligent Portfolios Premium. Great to have you here with us today. Thanks so much for taking the time breaking down this topic.
Thank you.
Certainly. Everyone, that's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. They have a very special panel discussing the Trump trade and how investors should view the second Trump term. Don't miss it.